those rates go.
Hey, Bramo, thank you. Great work as always. Lisa with the day ahead. Can we just take a look at the commodity screen this morning, Tom?
Yes.
Renewed hopes that China is about to reopen.
Yes.
And basically the whole of the commodity screen on the Bloomberg this morning is green. Brent crude 97, Tom. WTI close to 91.
Well, I'm going to do the banner right now on radio. You can see it. We migrate towards $100 a barrel Brent crude, the global price, not the American price. But the bottom line, I 100% agree, John. This is about Pacific Rim demand. Shout out to Jay Pulaski, who's called for this against the anti-science of China.
Well, he's been waiting for about 10 months for this to happen.
Well, okay, but we're all been waiting for the Chinese to get their vaccine act together.
Crude rallying up 2.5% on Brent. WTI up about 2.9%. Steve Whiting joins us now, Chief Investment Strategist, the Chief Economist at Citi Global Wealth Management. Steve, 8:30 Eastern Time. What are you looking for, sir?
Well, we're looking for continued gains in employment over the rest of the year. It's a deceleration. I think there's a lot of misunderstanding about what's happened. Employment since the beginning of 2020, it's grown all of 0.5%. But it's had 15 million swings, minus and plus, in the middle part of this. This is just upheaval and volatility, but it's the coming down portion of it now. What really matters is that businesses were catching up with demand over the past year. They were building inventories, they're raising production, they need employment for that. The problem is demand is slowing. And as we head into the coming year, we're expecting all of this policy tightening to hit. We'd expect about 2 million job losses net over the course of 2023. That's not going to be revealed here in a single month in 2022. So
what is the trend then on non-farm payrolls if you're going to have a 2 million job loss? I mean, do you get down to whatever the run rate is, 100, 150? Or are you suggesting a stream of negative statistics?
I think the negative statistics are next year. This is very unfortunate. Policy lags, the way they work. The simplest way to illustrate this is to think about the housing sector, where I can give you the simplest way of looking at it. If you think about what's happened to total construction spending or unfinished housing, it's fallen 2%. Sales have fallen 35%. Because the problem is it takes 6 to 12 months to plan a construction project and deliver it. So what is being delivered now is coming from a time when we had a much lower mortgage rate and a much higher sales pace. Next year, the people who are working on building those houses don't have a new house to build, and they're going to have job losses. And it's going to be extended not just in housing, but in marketing, sales, trade, finance positions. So many things that have happened with over $150 billion buildup in real business inventories this year. So you're just taking a look at the economy that on the production side is catching up, but the demand side is heading lower because of policy. Now, the Federal Reserve recognized it in their statement, but we just have to realize here, higher unemployment is U.S. public policy.
Yeah, and Stephen, we're talking about how we're basically up at the 30,000-foot level in an airplane. We know we have to land. We just don't know how hard the landing will be. We were just talking about that 210s inversion. This is this yield curve that typically portends recession when it does go negative. It is the most negative since the early 1980s. Does that have any correlation with the depth of the downturn that you expect next year and beyond?
It will have some effect. It depends on the Federal Reserve. It's not just the rate that they will reach, like you mentioned earlier. It's the rate that they will sustain. What will the Federal Reserve do when we have self-reinforcing job declines? They're just not looking at that right now. The rate of inflation is too high. The problem is that the most stable portions of inflation that they focus on, core services, literally are a member of the index of lagging economic indicators. They're strongest during recession. So you end up with a pro-cyclical monetary policy tightening into the recession and then pulling us out again and creating what I think is some needless volatility in the economy. You take a look at what's happened with money supply growth going from 27% now to 2%. In the coming year, it'll be negative. So the Fed is setting itself up, I think, to reverse some of this policy tightening. Unfortunately, they're going to wait until there's a good loss in the economy before that, until they're more worried about both sides of their mandate. And in effect, I think these job losses may lower the inflation rate maybe all of 0.5% in the coming year.
Well, that's the problem. Steve, thank you, sir. As always, Steve Whiting of Citi Global Wealth Management. Mark Ohana over at Bank of America talking about this morning. It's easy to pivot when unemployment's at 8% and inflation's at 3%. He goes on to say it's much harder to pivot when inflation is at 8% and unemployment is at 3%. And that right there is the problem. Steve's talking about when the mandate comes into conflict, maybe they'll back away. At the moment, they're communicating that they're not going to back away at all, even if the economy does roll over.
Not only one bank, but many of the central banks. And again, this goes to the degrees of freedom that are out there, run by a dollar with a 112 DXI, make it 113, shows strong dollar. I know, John, you're looking in Manhattan for housing this weekend. Bank rate 30-year new high.
Hey, I wish I could
breaking
buy
out
here.
to a new high, 7.x%. There it is. We're back to a 2,000 30-year fixed mortgage level.
It's as expensive to buy, Lisa, as expensive to rent. And that's not just New York.
And this is part of the problem, right? Because that goes into the CPI, but it also goes into people's household balance sheets, what they can buy, and how the pain being felt among certain tiers of income is just tremendous.
John, I just do simple math. How many bedrooms, figure out the rent, and it's unimaginable what a bed costs in the island of Manhattan.
I'm with you. Futures right now positive 0.6% on the S&P, trying to bounce back from an ugly week of losses on the S&P 500. Payrolls a couple of hours away. Priya Misra of TD in the next hour on this yield curve. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The monthly U.S. jobs report is out today, and the question is whether the labor market is cooling enough for the Fed. A Bloomberg survey says employers added 195,000 jobs in October, and it sees a jobless rate rising slightly to 3.6%. Slower growth in employment and wages would support the expectation that the Fed can downshift to a 50 basis point rate hike next month. Donald Trump has sent the strongest signal yet that he plans to run again in 2024. At a rally in Iowa, the former president said that he will, quote, very, very, very probably make another bid for the White House. The rally was for Republican candidates Trump is backing in Tuesday's elections. Workers are suing Twitter over Elon Musk's plan to eliminate about 3,700 workers at the social media platform. Their lawsuit claims the layoffs are taking place without giving enough notice. The job cuts will amount to about half of Twitter's workforce. In the UK, Chancellor of the Exchequer Jeremy Hunt is considering cutting the tax-free allowance for dividend income. Now, it's just one of the options on the table. Hunt and Prime Minister Rishi Sunak are looking for $56 billion in spending cuts and tax increases. A big sale for Airbus. China Aviation Supplies has agreed to buy 140 of the European plane maker's jets. The list price is about $17 billion. Although discounts are usually given for big orders, most of the planes are A320 single-aisle aircraft. The announcement was made while German Chancellor Olaf Scholz was taking a visit to Beijing. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
I'm going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city, it's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
The top names in business are on Bloomberg.
The financial services industry, which is a large part of the UK, is very competitive. But it's not the only one. Health sciences, even technology and fintech are very, very bright stars in the UK.
The market environment is a very challenging one. It's not about blaming the markets. The markets is the same for everyone. And that's exactly how we deal with it.
90% of our clients are indicating we need more guidance. And if they want more guidance, that's why they bring their money to us.
Nobody covers business like Bloomberg, your global business authority.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
The top names in business are on Bloomberg.
This was not a solvency issue at all for the pension system. It was a liquidity issue. So a liquidity problem had to be managed.
Nobody covers business like Bloomberg, your global business authority. All eyes are on the October jobs report.
The unemployment rate needs to rise for inflation to come in. We may be seeing a Fed that doesn't have to do a whole lot more.
Today, Tom, John, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
To preserve jobs in the long run, we need to kill inflation.
We have a long way to go.
Creating pain in the jobs market is not what we want to do.
Is it worth paying this price to get inflation down?
The October jobs report, today on Bloomberg Television and Radio.
Folks, look, this is a choice between, everybody talks about a referendum. It's not a referendum. It's a choice. A choice between two fundamentally different versions of America.
The President of the United States on the campaign trail yesterday evening. Someone else was on the campaign trail yesterday evening as well. It was the former President, Donald Trump. And this is what he had to say, Tom, in a rally last night. And now, in order to make our country successful and safe and glorious, I will very, very, very probably do it again. That's the closest the former president's come, Tom, to announcing maybe another run at this office.
We'll see. Very, very, very probably we're going to get a briefing here. We're all going to dive in and take notes with Anne-Marie Horton because we will be in Washington for the election. It's going to be interesting. John, what is it? Tuesday we're there?
Tuesday
and Wednesday.
And Wednesday too. Okay. Pre-game, post-game.
Pre-game, post-game. I like it.
Not that it's a game. It's serious stuff.
Yeah, it
Before
is.
people start writing it, I know.
Anne-Marie Horton's going to brief us. Anne-Marie, I want to get out front of Wednesday. I want to get out front of 9 a.m. Wednesday. We're like heading out to, Reagan to come back up north. Great. When they become new chairman, when, say, French Hill, who's a Republican from Arkansas, becomes, I guess, chairman of the Financial Services Committee, whatever, how does their lives change? How do leading Republicans' lives change Wednesday morning?
Well, they don't immediately, and we should note that we may not know every single district or state's final tallies by Wednesday morning. Many are projecting it could take a few days to count all these ballots. We already see more than 30 million in early voting. So in that part, we should note that we might not have the full picture of what next year's Congress will look like. The second part, Tom, is that nothing's going to change, obviously, until next year. So what you're going to see is a lame duck session until the end of the year. And actually, we heard Bernie Sanders, the senator from Vermont, talk about this yesterday. There are some items that Democrats want to push through, like potentially raising the debt ceiling, because this is something that they plan a showdown with for the Republicans at the top of the next year. You're yang me, but I mean, that's what it's going to be.
Truman was president.
I know, but it's
it's like a religious experience. We argue about it. Amory, seriously, why are we arguing about the stupid debt ceiling? They always raise it, right?
They do always raise it. It's this perennial debate that goes on forever. At the end of the day, they get it done. You're 100% right. The reason why we're talking about it right now is because Republicans have come out and said that they are going to use it as leverage to get entitlement cuts. And now the Democrats are actually campaigning on that message.
Anne-Marie, John just whispered to me, would you ask about Trump? Okay, I'll ask about Trump. What's the likelihood the former president will take another shot at being president?
Well, this is what he said last night. Very, very, very probably that he will make another White House bid. Those are three verys. But we also should note that we had Kellyanne Conway as well yesterday speaking at an event, and she said he can announce a comeback bid, quote, soon. So this was really two hints that the former president is going to be looking. And also, was he really in Iowa campaigning for Chuck Grassley, or was he himself putting it out there? This is a very important state, obviously, for the caucus, putting it out there that he plans to make this announcement after the midterms.
I love the rhetorical question, Anne-Marie. Is this really him? And what do you really think? I'm sure that everyone's wondering and scratching their heads. Does this give the Democrats actually unwittingly a boost, or does it give the Republicans something of a boost just in terms of turnout and enthusiasm heading into next Tuesday?
Well, I think the Republicans, the Democrats, are going to use this, Lisa, as Trump's planning to make a comeback. He's in these states talking about a number of individuals, especially we do see a midterm election where there are election deniers on the ballot. Look at Arizona and Carrie Lake, who's leading in the polls to be the governor there. She's become this superstar of the, quote, MAGA Republicans. So you'll see Democrats point to these individuals, and as Biden will say, that is a critical moment in this election. At the same time, for the Republicans, a lot of them will be using Trump's, superstar kind of celebrity status when he has a number of campaign rallies he plans to continue doing. But there are others who as well want to distance himself. So it really depends who you ask. I think it puts Ron DeSantis most notably in the most difficult position, and Trump will be going to Florida.
I think he's the unhappiest man in America this morning off the back of that statement, to be honest with you, TK. AMH, you want to squeeze this in just quickly? Perhaps the biggest story internationally outside of the United States, Chancellor Scholz is in China. What is going on over there?
Not just Chancellor Scholz, look at who he's bringing. He's bringing VW, BASF, a number of heavyweight companies. John, as you said a number of times, Germany is so reliant on China for their economy and really their growth. He's only there for a one-day trip. The most important thing that has come out so far of this meeting is that Xi Jinping has said he does not want to see nuclear warfare on the continent of Europe, and that was really I believe, a direct line, a moment of him to signal to President Putin, do not go there.
AMH, great to catch up. Anne-Marie down in D.C. All these conversations around China at the moment, TK, potentially reopening. You see the equity market in China this week. It is absolutely
People use the word
ripped.
frenzy. Seriously.
I think you can call it a frenzy.
Yeah.
You can call it a frenzy.
I see nuances here, and I think Enda Curran's been great. Steve Major the other day was great on the urge to get it open. And I'll go, maybe it's an elitist thing, but I'll go to travel and monitor the air travel, and it appears to be loosening up.
That's what's fueling the move today.
Yeah.
So we started the week with the reopening rumor, and it is just that at the moment because it hasn't been confirmed as to whether this country at the moment has to put together a committee to assess whether they should drop COVID-0. That was the rumor at the start of the week. But this headline this morning fuels that rumor. Lisa, China is working on plans to scrap a system that penalizes airlines for bringing virus cases into the country. This is our reporting here at Bloomberg, according to people familiar with the matter. But that just fuels the hopes, the rumors, Ramo, that maybe this is going to happen.
Especially in tandem, going back to what you said about Olaf Scholz heading to Germany with a bunch of different executives, and then announcing today, Olaf Scholz of Germany, saying that China will make BioNTech shots available to expats. Just there seems to be some sort of shift in reopening. These are the first meetings that Xi Jinping is having with a number of heads of state, including the one that's upcoming with President Biden. I just am really not understanding the sort of paradox here of saying we recognize that there are new tensions. We want to move supply chains away from you. We don't want to be as reliant on you. And oh, by the way, Olaf Scholz also saying we do not want decoupling. Well, I can't square that.
Germany's the weak link in that effort every single time, it seems. Every single time, whether it's Russia or whether it's China, Germany seems to be at the epicenter of that conversation.
Germany is not alone, though. And honestly, not to get them off the hook, but every Western nation might be speaking a hard line, and people are wondering whether President Biden is speaking a much harder line than he can really follow through on, and certainly the businesses, because they are still going over there and they are still courting Xi Jinping and Beijing more broadly.
Commodities rallying off the back of this. Equity futures up as well, up 0.7% on the S&P 500. Big day of gains ahead. That decision is at the mercy of what happens in the labor market. That data is coming up in about 2 hours' time. From New York, this is Bloomberg.
Stronger that moment that you're lifting the barbell, you get stronger as your body is making repairs, making recovery. Recovery is when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
No one covers the world like Bloomberg.
The writings on the wall for the Bank of England. Just Stop Oil has spray painted the front door.
Recession in Europe, UK, and possibly the US.
Brazilians are out in full force celebrating the election victory of former President Lula da Silva.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
2 hours away from the payrolls report in America. Going into it, we're looking for something like 195,000 in the jobs report for October. That's the median in our survey here at Bloomberg of Wall Street economists. Futures right now up 0.7%. On the Nasdaq up 0.8%. On the Nasdaq 100 this week, we are down lower, negative by 7.4% through Thursday. Could be on course here for the worst week, going all the way back to the start of the year. In the bond market, guess where yields have been this week? Moving the other way, higher, much higher, by about 30 basis points to the front end on a 2-year. On the week, on the session, up another 3 to 474.23, Tom. That is quite a move in this bond market.
I haven't even mentioned, John, are you doing the real yield this afternoon?
I'm not, no.
Oh, okay.
No.
Okay.
Katie Greifeld's going to fill in.
Very good.
Looking forward
Ms.
to that.
Greifeld's going to have a real yield of 1.74%. I think that's been undersold this week.
Two tens right now.
From like roughly a 161 up to a 174 in the 10-year.
So that's 0.1. Let's do 0.2, and it's your point. 2's tens. Negative 60.
This is huge.
Negative 60.
Yeah, folks, you go back and there's been dip 1, dip 2, dip 3, dip 4 since the 80s. We're now through those. You know, there's no other way to put it, greater inversion. And again, we're back to the Volcker years there in 1980. I'll let somebody figure out to the 12-month period what it is. On Jobs Day, and it is an odd Jobs Day, as it's been an odd Fed meeting and an odd Bank of England meeting, we are briefed by Rubila Faruqi, Chief U.S. Economist with Carl Weinberg at High Frequency Economics. You know, I look, Rubila, at your report, and I want to dovetail your sound market economics with what Nick Turner at our tech division calls the new tech austerity. Explain Jobs Friday with the tech austerity we're seeing in different shades from Lyft, Amazon, Apple, and the rest.
Good morning. Thanks for having me. Yeah, I mean, we expect to see a shift in the labor market, right? I mean, we are looking at job, the layoff announcements, they're picking up. We're looking at the tech sector. We're looking at some shifts in certain sectors of the economy. But what we're really seeing is just not a broad-based, weakening in conditions. The labor market is still very tight. Demand for workers is still very tight. If you look at job openings, if you look at the vacancies to unemployed ratio, those signals, if you look at the layoffs, those signals are still very strong in terms of underlying momentum and strength in the labor market. Now, what do we expect to see? You know, we've seen a rise in continuing claims over the last 3 weeks. We are watching for signals of a shift. But right now, there's nothing to suggest. We're looking for very robust job gains again this month. Deceleration, but still very robust. And an unemployment rate that's really not coming off of a 50-year low.
Page 3 or page 4 of your high-frequency economics note always rips apart the 10-year yield and the yield curves and slopes that we see in fixed income. Take a negative 61 basis point 2's 10 spread and bring that over to our job economy. How do you link those two together?
I mean, that's a difficult. I mean, the signal from the yield curve is one of recession, and it has been a very strong signal, historically very accurate. But we're not seeing the signals in the economy that we would need to see. Look at employment, look at production, look at incomes. And yes, wages are not keeping up with inflation, but wages are still rising at an elevated pace. And look at what's happening to real disposable incomes. We saw extreme negatives, and now we've turned positive again. So the signals that we would expect to see after this much of tightening from the Fed, they're just not there right now. That doesn't mean it's not going to happen. But really, recession is not part of our base case right now. We do think that this economy, this consumer, has positive momentum. Deceleration is the name of the game. That is going to happen. But we're just not sure that we're going to tip into negative. That's not our base case right now.
We just got through about 87% of the earnings season for the S&P 500 on a market weight basis. They're trickling in the finish. But have you seen some of these companies pull back on investments at a time when investors certainly are pulling back on any kind of material risk taking, since they're earning more right now in benchmark 2-year yields than they are many risky assets with the earnings yield basically flat or close to it with that 2-year yield?
Yeah, and that's where there's sort of a disconnect, right? Everything that we would expect to see, in terms of profits and where investment is going to go, that's also not appearing, right? We saw business investment actually improve in the third quarter. But, a lot of uncertainty surrounding outcomes going forward are, we would expect that there would be an adjustment. There are a lot of headwinds, there are a lot of cross currents, but really no clear. If you look at company guidance, you do see that there are a lot of headwinds going forward, but it just hasn't appeared yet. And I do think that we're going to see an adjustment over the next few months and maybe going into 2023.
So does this data matter? I mean, or is it so backward looking that it can't really tell us anything about how quickly in the other direction we're moving?
No, you're right. I mean, the data is backward looking, but of course it matters because we do want to see what was happening, in the labor market, what's happening with inflation, but especially, the labor market right now, right? Because the Fed is taking action. They want to see, some softening. It's really not happening. So, but you're right. I mean, if you look historically, you can go from positive to negative, right? I mean, you just, as you move into recession, that positive numbers goes negative very quickly. There's just no sign right now that that's going to happen.
Rabila, long ago and far away, we hung every, I believe it was week, on the Challenger layoff statistics.
Right.
Are they still valid? Are they something you and Carl look at still?
Every little bit of information is valid, right? I mean, we do look at what we are getting in terms of, data from every avenue. It's just that there has been this disconnect.
Right.
We hear about, certain sectors. We hear about, like you brought up earlier, you talk about tech sector layoffs, but that has not translated into a broad-based weakening of the labor market. So yes, we're still looking, but the fundamentals are still very positive. There is still positive momentum in the labor market. There's still dislocations. Demand is still very strong. So it's very hard to say that when is this going to turn, when are these outcomes going to turn negative? And we just don't see that happening right now. But probably in 2023, that is probably when, when we're going to see the adjustment. We do see the unemployment rate going up. We think it's probably going to top out at 5%, 5%. But again, no indication right now that this adjustment is happening.
Rabila, one final question, because we've got to move on here with the way the markets are moving, particularly the inverted yield curve. I'm looking at the inverted real wage, and not to get calculus here, but the integran, the duration, the extent of that negative real wage is tangible. We have an election coming up on Tuesday. Is that really what this election is about? Is it after inflation adjustment, everybody's flat on their real wage back?
Yeah, I mean, we've been talking about this for a while. Real wages have been negative. Consumers are suffering, especially people at the lower end of the, wage spectrum. But again, we have other dynamics in play. We've got, as I said, real disposable income is turning positive. We still have, Fed research shows that there are still a lot of savings on household balance sheets. So, yes, people are paying more for rents. People are paying more for more for food and energy. But at the end of the day, I don't think that consumers are really seeing the type of stress that would lead this economy into recession, not right now. But in terms of elections, of course, that matters. And that's probably going to be, a big factor in the outcome next week.
Rabila, thank you, as always. Rabila Farooqi of High Frequency Economics. Let's build out a couple of these themes and pick out one on the labour market. So we can see the pain in tech right now. Amazon freezing hiring, layoffs at Lyft, layoffs at Stripe. You can see it with the chip makers, Qualcomm freezing hiring, Intel cutting jobs, cutting spending. We've got to ask ourselves, is this a tech problem because that's where the excess has been for the last 10 years? Does that mean this is going to stay quite narrow, or do we have a broader issue?
Oh, yeah, that's the question. We don't know. I mean, I think everybody's got an opinion. But I think the answer, what Jay Powell would say, is we got to wait for the data.
Well, that's going to play into the whole debate around short and shallow, right? The consensus view is that this recession will be short if we get one, Lisa, and it will be shallow.
Yeah.
And that's because most people assume that we haven't had long enough time in this recovery, because they count 2 years, not the last 10 years before the pandemic, to build up the excesses to lead to a big, deep, prolonged recession. That's the argument at the moment.
A lot of it has to do with a lack of leverage in the household sector, right? You don't see the same kind of mortgages that are, 5% down payment and the rest is financed by cheap rates that suddenly people have to deal with. It's not the same kind of 2007 feel. That said, I was just reading a story about the housing market and how quickly it's decelerating, to Tom's point that he's been talking about. And if you start to get much slower pace of home purchases, what does that do to the broader economy? That is one of the key generators for jobs, for activity, for building, for home goods, all of these different things that have been such strong players in the post-pandemic era. I mean, how many sectors were really blown into some bigger state that are going to have to shrink a bit in this new reality?
We're not seeing it show up in the data, Tom, in a major way yet.
No, we're not.
And that's the issue for the Federal Reserve. I think they're emboldened by these lagging indicators to carry on hiking and keep on pushing.
The massively ex post and what we saw from Bailey yesterday was stunning. John, we're forgetting the big event of the weekend, and I need you to explain this to me because
What's that? What have we got?
I was on the edge of the tots there. I was down when Sun scored 3 goals and all that, but the rowdy crowd at the tots in the end zone is nothing like
call it
Liverpool.
The end zone.
Yeah,
you know,
behind the end zone. It's nothing like Liverpool. Explain how sanitized the Tottenham experience is compared to Anfield and what the madness up there.
Can I just engage my camera again before we start this conversation? Just quickly, if you get my single up. I have to do this every single day. I'm sorry that we're having this conversation. The end zone, anyway.
It's the end zone.
Sir Alex Ferguson, which was the former Manchester United manager, used to complain that the fans in the stadium were just sitting there eating prawn sandwiches and weren't taking in the game.
Yeah, okay.
I think the problem with the new stadiums, and I think modern-day football in England, they've priced out the traditional fan. It's so expensive now. I was speaking to Mohammed the other day about the price of a season ticket at QPR. QPR's in the league below.
Right.
Something like £500 or something for the season. If you're in the Premier League, you are talking multiples of that for a top club. Thousands and thousands. So can you imagine trying to take your kids every single weekend to the game?
Lisa,
and they're going to be the people that make the noise,
we need to go to Liverpool to see, I think what he's saying is we need to go see real soccer.
I don't think you can price, I worry when you start to price out the real fans.
How about the 3 of us with Ian Shepherdson at Newcastle?
In Newcastle, now there's an experience.
I love you just went right over the
Christmas,
soccer.
Day after Christmas, Boxing Day, years and years ago, I remember going to watch West Brom versus Newcastle United. Freezing cold. Newcastle away fans, shirts off, Tom. Shirts off in the freezing cold. Real fans. Coming up, Tom Porcelli
in the end zone
of RBC. I'm letting that go. I really am. Futures up 0.8%. The jobs report just around the corner.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. jobs report that comes out in less than 2 hours is expected to show that the labor market is still tight. According to a Bloomberg survey, employers added 195,000 jobs in October. Meanwhile, the jobless rate is estimated to have risen 0.1% to 3.6%. Oprah Winfrey has thrown her endorsement to Democrat John Fetterman in the Pennsylvania U.S. Senate race. Fetterman is trying to win a tight contest against Mehmet Oz, the Republican who is one of Oprah's former proteges. Oz is a celebrity doctor whose rise to fame began as a frequent guest on Winfrey's talk show. He later hosted his own successful program. In China, there's a sign that authorities are looking for ways to ease the impact of the COVID-0 policy. Beijing is working on plans to scrap a system that penalizes airlines for bringing virus cases into the country. Right now, carriers are banned from specific routes into China for up to 2 weeks, depending on how many COVID-positive passengers they carry. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
From the US's point of view, it's about tightening conditions in the US. The US economy is still doing well, so there's no obligation for the Fed to take into account wider conditions. There will still be repeated efforts to price in a Fed pivot trade through equities, through bonds, through FX, through the dollar and the like.
Jeff Yu, one of the very best of BNY Mellon, the senior market strategist, weighing in on this FX market. The market looks like this going into payrolls. We're higher by 0.8% on the S&P 500. The jobs report just around the corner, 8:30 Eastern time, looking for something like 195K. That's the median in our survey here at Bloomberg. Yields are lower by not even a basis point on a 10-year, 413.74. Euro firmer, dollar weaker, 97.89 on euro dollar at 0.4%. The rumor mill gets more fuel over in China for a reopening, and this commodity market continues to rally. $91 on WTI. We're up by more than 3%. Tons of engagement on the football chat moments ago. Official correction, Tom. It was Roy Keane, the former Manchester United captain, not the manager.
That's a major correction.
Manchester
That's a
United,
faux pas major level.
that coined the term the prawn sandwich brigade.
Okay.
I'm told by many people this morning. They were less concerned with your end zone comment and more concerned with the fact that I got that
That's
wrong.
because they know smart, adult, pro football, soccer idiot. That's the way it works.
I'm not sure that's how it goes, but seriously, they are like libraries sometimes, those stadiums, Tom.
Oh, yeah, we have the same problem. here.
So
same
quiet.
thing. Hockey.
It's a problem.
Same way. Yeah, it's very true. Okay, what we're going to do here is do what Bloomberg Surveillance does best. We love to talk to people who've been wrong, because we can study why they've been wrong and learn from it. For example, the great Binky Chadha with us at Deutsche Bank, who's had a bull call through the year, and maybe he's extending that into 2023. We also like to talk to people who've been right. Priya Misra, to join us later here, has been brilliant on curve aversion. And then there's Anna Wong, chief U.S. economist here at Bloomberg out of the Chicago shop. And she has the economic call of the year is everybody. John, help me here. Nomura is out Anna Wong and Anna Wong this morning.
Nomura's at 550 to 575
right.
Fed funds next year. That's a big call. Anna Wong and the team, and Anna's going to walk you through it now.
Yeah.
They're basically looking at their model and it's saying 100% recession next year.
Anna, help us with a 5% terminal rate. Does the financial world fall apart?
Well, we think that's, well, you know, financial world react to expectations where rates are, right? So pretty much a 5% is priced in right now and nothing's breaking. The mortgage rate at 7.1 is already basically pricing in that path. And we've seen, yes, it's clear that, you know, housing demand is falling sharply, but that's the kind of adjustment that is needed given how overpriced it is. So, and I think the population in the lower half of income are probably cheering that right now because a lot of people want to buy houses but could not afford to.
Yeah, I know out of Chicago, Anna, you got two dogs at home. One is named Long and the other's named Variable. Everybody's quoting Long and Variable lags from Milton Friedman. Forget about it. Let's go Gary Becker. What are the social consequences to America on this jobs day if we have rates revert and real rates revert back to what I knew in my youth? What happens socially to America?
Well, I think socially to America, what people care about will be revealed in the midterm elections that we will see next week. And what we are seeing in America is red versus blue states. And in red states, people are feeling very passionate about the issue of inflation, and that's partly because misery, there's a thing called misery index, which is the sum of unemployment rate and inflation, and that index has historically kind of tracked midterm reactions outcome pretty well, and that would suggest that the misery increase in red states under the Biden administration has been bigger than the blue states, and that kind of underpins why there's so many angry people in the red states.
And there's nothing to anger people quite like losing their jobs, right? And that hasn't quite happened to the extent that people are predicting, and some would argue is absolutely by design in terms of the rate hikes that we've been seeing. Is your sense that there is credence behind that perhaps there won't be as many layoffs as people previously thought, just simply because businesses were burned during the pandemic, not being able to bring people back?
Yeah, I think the slow adjustment in the labor market right now is because right now we're frankly not seeing much adjustment needed to bring inflation down from the Fed's perspective. Well, the reason why is probably because firms are hoarding labor and they don't want to go back to a world where they could not find a person to to man the counter behind, But I think that you can't, the Fed cannot have it both ways. You cannot have no unemployment and also inflation coming down. And that's because when output does slow and we are seeing, real GDP growth lingering around, 0 to 0.5% for the next few quarters or so. Well, when output declines and you do not lay off people, that means that productivity is also rising. And when productivity is falling. So if productivity is falling, either the firms have to lay off people, which gets you back to the beginning of that circle, or firms have to pass on the higher unit labor cost to final prices, so you have inflation. So you can't have, I just don't see how you can have both low inflation and no firing happening in this dilemma that we have.
So far, we've really seen the layoffs isolated somewhat to the tech names in terms of how big they have been. What other industries are you watching? What other industries do you think are potentially vulnerable to these types of announced layoffs in the near term?
Yeah, so we looked at the sectors which are seeing the most significant declines in job openings, and we did see that it's isolated to sectors which had hired robustly during the pandemic. So they would be in sectors like transportation and warehousing, constructions, Wall Street jobs, and tech jobs. And if I had to tally all of them up, I think that the sectors that are vulnerable to sharper layoffs would account for about 11% of total employment, and so that's not a
Right.
small number, but that's not a massive number either.
Anna, nobody's watching. Give us an estimate here. If we get an Anna Wong world, what's the unemployment rate?
We think that ultimately unemployment will rise to 4.9% in 2024.
Okay, see how she nailed that?
I know.
That was because she
Well,
wanted to
knows
show
her
us
numbers,
what the
Tom.
two digits.
I assume that's what she thought you would lead with.
No, it was great.
And then didn't.
4.9%.
Anna Wong at Bloomberg
Others are going
Economics.
higher.
I'm going to say thanks to Anna.
Yeah,
Anna, thank you. You can't fire what you couldn't hire. Lisa, how many times have we talked about that over the last couple of months?
How long does that last, though, for?
Sure.
I mean, at what point does the economy readjust faster than people can really stick
That's
with
where
that kind of
McKee is.
credo?
Yeah.
And the Fed's going to keep leaning into it every time we don't see these kind of cracks.
We're talking about the yield curve, and it relates exactly to this idea of corporate investment. Because if you think about this, if you're getting the most yield on a 2-year treasury versus a 10-year treasury that you've ever seen going back to the early 1980s, what does that make you want to do with your money? You want to stuff it in cash, and that is what people are doing. And that's a profound implication for a lot of these businesses.
I couldn't agree more. 2's, Tom, negative 60. Negative 60.
Yeah, I mean, historically, that's a huge deal. Stuff it in cash. How can you insult a triple leverage cash fund?
I'm not. I'm basically saying that everybody's following your trend. You're avant-garde, Tom.
I'm very avant-garde.
I mean,
yeah,
look
but
at
they
this.
don't have a
Tom's on trend.
but they don't have a 220s
It
payout.
took
Tom's on
10
trend.
years, but definitely.
Let's get to someone who actually nailed it. Priya Misra of TD.
Amen.
Up next. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
November 8th, as Americans decide the future of Congress and state legislatures, Bloomberg will be live in Washington, D.C. to cover the results as they break and provide insight about what it means for the country.
We're in a divided country, and these are really close elections. We take a look at what the races could mean for Wall Street.
Special election night coverage starts at 8 p.m. on Bloomberg Television and Radio. And tune into Surveillance live from D.C. at 6 a.m. on Wednesday for the latest overnight. This is Bloomberg. The top names in business are on Bloomberg.
This was not a solvency issue at all for the pension system. It was a liquidity issue. So a liquidity problem had to be managed.
Nobody covers business like Bloomberg, your global business authority.
There's just a lot more momentum in the U.S. economy.
There's no obligation for the Fed to take into account wider conditions.
The Fed speakers are going to be focused on that lag effect between policy tightening and actual economic impact.
For economies that are fighting inflation, a weak currency is a problem.
This suddenly more hawkish tone, it's pretty confusing. It's confusing not only for markets, but just generally, globally, and for other central banks.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is Payrolls Friday, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures positive 0.7% on the S&P 500. TK, the jobs number, 90 minutes away.
We got a little lightness here talking Tottenham and Liverpool. Forget about it. This is a serious report. We come off a Fed meeting that shocked, a Bank of England meeting that I felt was more shocking, John. And now we come to this jobs report amidst what Bloomberg calls the tech austerity of this Friday morning.
Off the back of an equity market that's been absolutely hammered, a bond market that's seen yields surge to highs we haven't seen since 2007, and a curve, Lisa, a curve that now sits at negative 60 basis points, twos compared to tens.
And people are responding as they logically should, which is they flood into cash. And that's what you just saw. You saw the biggest, you're on pace for the biggest inflows into cash funds going back to the second quarter of 2020 amid the peak of the pandemic. How much is this going to continue? And when does that take enough momentum out of some of the other areas of the economy where you start to see the pain that the Fed is actually looking for?
That's my favorite note of the week. Michael Hartnett of BFA with the flow data.
You did that. You put
Always
that on
enjoyed
Twitter.
that. Always enjoyed that. Crude's rallying today, guys. Brent crude up 3% to 97.50. WTI up 3.5%. WTI with a 91 handle. Tom, the China reopening rumor mill gets some fuel today.
Yeah, I'll go with that. And it's cascading. It's every day. There seems to be another little blurb. You wonder where this stuff comes from. It's got to come from the government. John, moments ago, the 10-year real yield rounded up. We went through 1.75%. That is remarkable.
Can we live with that? I think that's the question for our next guest, Tom. Can we live with that?
We're gonna do that with Priya here, but I would just suggest, folks, this is incredibly rich today. I went back and looked, John, 10% unemployment October of 09. It's different now because the unemployment rate is so low, but the tension that's there today into 8:30 is genuine.
And the fact that inflation is not at 8% then.
You had that from our,
That's slightly problematic too. Going to whip through the price action for you just briefly on the S&P 500. We look a little something like this. Futures shaping up as follows, up 0.8%, yield higher by almost a basis point on a 10-year at 415.63. It's the action at the front end of the curve. We're up 30 basis points or so on the week on a 2-year. Tom, that's quite a move on a 2-year yield to see it through 470 over the last couple of days.
Again, it's the rate of change. It's the speed of movement that we're seeing there. And, into the election, John, can we say Wednesday morning, Tuesday morning, when we're in Washington, can Joe Biden enjoy $100 Brent? It's feasible.
I don't think he wants that number going into the midterms.
But 97.47 on Brent crude and moving
in the wrong direction for them?
Yeah.
I think that's a good way of putting it. Bramo, WTI, $91.16.
Definitely something we'll be talking a lot about next week when we're in Washington, D.C. Today, it's all about jobs, as we've been talking about, 8:30 a.m. In about 90 minutes' time, we get that U.S. change in non-farm payrolls. Will it matter what the headline number is, if it's 200, if it's 190, if it's 220,000, or is it really going to be the wage picture? How much are wages decelerating in terms of how quickly they are rising year over year? This might matter more, just simply because it gives you more of a sense of where the pressure is, what companies have to do to lure in employees, and which employees are the ones that they actually want. Also, we're going to be hearing from Labor Secretary Marty Walsh, joining John at 9:30 a.m. How do they pivot to a constructive message ahead of next week's election, given The Federal Reserve has explicitly said that unemployment needs to rise in order to get inflation down. Today, talking about layoffs, Twitter is planning to inform about 3,700 of its employees, or about half the company's workforce. They no longer have jobs. This is, of course, an Elon Musk issue as he comes in and tries to cut costs. But how much is this a tech issue? How much is this a broader issue that has yet to feed into the market? John, you were talking about how is this just an isolated case because this is the area that benefited the most over the past 10 years? Or is this a predecessor to some of the job cuts that we are going to see, but not seeing yet? Certainly not in the jobless filings that we just got. And at 10 a.m., we hear from Boston Fed President Susan Collins at a Brookings Institute event. How much does she talk about the terminal rate? Right now, we are pricing in, and I'm really shocked by this. I was looking at the Fed funds futures, a 5% or higher rate for the majority of next year, pretty much the entirety of 2023. Have we priced in the implication of that, John, especially at a time when you do have this yield curve inversion that will only get steeper as we realize that type of level?
Lisa, thank you. Thank you very much. Tom, fascinating to see the Fed speak over the next couple of days.
Yes. Yeah,
do we
totally
see a split?
Agree. Totally.
Or are they all on the same page still?
Do we have a cumulative whatever?
That leads into the statement and a group that leads into the news conference? Yeah, I'm with you. It's going to be fascinating the next couple of days.
Why don't you bring in her worship?
I plan to. Priya Misra, Queen of Rates.
Queen of Rates.
Queen of Rates.
All the year.
Head of Global Rate Strategy at TD Securities. Priya, great to catch up. 210s, very close to -60. I think it was a number of months ago you said we could test these levels. I think we're all trying to work out, Priya, whether we can push this much further than where we are right now.
I think it all depends on the inflation number. If the inflation number remains high, I think we can absolutely flatten further. I do think there's a limit to how much we can flatten because, you know, at some point, the front end's going to give you the most amount of yield. If the labor market's strong, which we expect another strong report today, I think people move to the front end. And so where's that demand? Remember, the Fed's also doing QT. So I do think there's a limit to the inversion because there's a lot of supply that's coming in, 5 to 10 year part of the curve. And ultimately, that's what's pushing real rates higher. So I think we stay around here. But we can absolutely flatten further if inflation remains high, broad-based. I think there is some more room for that flattening.
Priya, I'm not going to do a log x-axis. I'm not allowed to do that on TV across America. But I will say this. If you get the Priya Misra world, does the short end of the curve begin to move out the duration? Do we go from a 1-year study to a 2-year study, a 2-year study to a 3-year study? Do we ebb out into longer duration?
You know, I think it's hard to call the top in yields, but I think, you know, you're supposed to start to look further out the curve. I mean, look at the move in real rates. In all the talk around how high the terminal rate is, I think what's being missed, you guys keep flagging it, but I think the market's missing that 10-year real rates are at 175. I mean, that's getting close to 2%. I think there are lags. We are all talking about lags. I would argue the lags are actually longer, not shorter, because the consumer has the savings buffer. The savings buffer is coming down. I think a high real rate is going to put pressure on the economy. You're supposed to start legging into duration. You know, is that now or is it early next year when we start to see the slowdown in the consumer? That's a harder call. But I think starting to take some duration risk as your recession hedge. You know, just keeping money in the front end is not going to be a great recession hedge once the Fed starts to cut rates. I think they're going to be late to start to cut rates. So you've got time to leg into duration. But I think, you know, above 4% 10s is cheap, you know, given all the tightening in financial conditions that we've seen.
When we talk about real rates, is basically how accommodative or restrictive the Fed will remain over a very long period of time, and a question of how long the market will remain restrictive or demand a higher premium to borrowers, both corporate and government borrowers. Which market is not understanding a nearly 2% real rate right now in the 10-year?
You know, I would say the government, particularly the U.S. government or you know, any government with fiat currency, I think for them, real rates is not a big issue because they can always print their way out of this. It's the corporate sector. It's the housing market. I think that is responding to high real rates. Now, you know, the U.S. has these long-dated mortgages that are fixed. So you may not see that in household leverage, and household leverage is lower. I do worry about the corporate sector. The longer we stay at these high real rates, you're going to see credit contraction. And that just takes a while to feed through into the economy. I think you start to see it in business investment starting to slow down. I think banks start to pull back. And ultimately that shows up in a weaker economy. But these things just take a while. And I think the market's looking at, well, there's no buyer of long end fixed income right now. And I'm getting higher rates and just staying in cash. I think that's why you've seen this move in sort of the, what we call the belly of the curve.
And some people say, well, it's not going to be a credit crisis akin to what we saw in 2009. But is there a period that's analogous that we can point to in terms of what you expect to eventually get priced into the corporate sector?
Yeah, I think, the wall of maturity is really 2024, 25. That's where I think companies have termed out debt very smartly because, rates were low, spreads were tight. But at some point, if earnings start to disappoint, I think then as these companies start thinking about their debt burdens into 24, 25, I think that's when they actually start to curtail. And we're going to start to see job losses picking up. I think it's still very small. It's more a second half next year. So I think what the market's underpricing is Fed easing in 2024. I think they're going to stay resolute. They want inflation lower. We think you get close to 3% inflation by the end of next year, which will then allow the Fed to focus on the second part of their mandate, which is full employment. So those are the eases in 24, but I don't think they're going to give us forward guidance of this. So I think for companies, as they look out and they see these high real rates, it has to factor into their hiring decision, their investment decision. So we'll see more of that, I think, through the course of next year.
Priya, brilliant, as always, just fantastic and great call on the yield curve a number of months ago on this program. Priya Misra there of TD Securities. Can you imagine if the Fed had an open conversation about what Priya just talked about, which is rate cuts in 2024? Can you imagine if they start, we're going to do this, but we're going to lean against it later on and we're going to cut?
To me, and I get it that there's money to be made and the money to be made lost on this, and it's a legitimate trading thing, but I don't think a bunch of economists are sitting around right now trying to figure out the magnitude of a pivot when the pivot comes. I mean, that's something new.
We're trying to work out, Lisa, the damage that will be done based on what's priced into the rates market already. And still the consensus is short and shallow. Still. And it's getting firmer. It's not getting a softer consensus anytime soon.
Well, that's what I was going to say. You're saying, can you imagine if the Fed said this? The market's pricing it in, and the market's expecting it. And so at a certain point, it doesn't matter what the Fed is going to say. This is what people believe and are trading on.
That's what he's leaning against
right.
in the news conference. He's trying to signal anything but. He's trying to push the terminal rate higher.
The last 3 days have been bizarre. Can we say good morning to Scotland?
Of course we can.
Fan calling, is it Celtics or Celtic?
It's Celtic.
The Celtic is
Celtic's the football team, sure.
The football, Celtic Dundee United.
Is that the game this weekend?
Celtic Dundee United.
You want to watch the Old Firm derby, Celtic Rangers, when they play?
Yes, I'm told it's big.
That's a real game.
He said Celtics is the best crowd.
Well, I'm sure Rangers fans might have a different opinion.
Is it the same as English football? Is it
it's a different league. It's a different standard now.
Same ball.
But I'd say the atmosphere is better.
They both have an end zone.
They both have an end zone.
Good.
That's right. Futures up by 0.8% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The monthly U.S. jobs report is out today, and the question is whether the labor market is cooling enough for the Fed. A Bloomberg survey says the employers added 195,000 jobs in October, and it sees a jobless rate rising slightly to 3.6%. Slower growth in employment and wages would support the expectation that the Fed can downshift to a 50 basis point rate hike next month. Donald Trump has sent the strongest signal yet that he plans to run again in 2024. At a rally in Iowa, the former president said that he will, quote, very, very, very probably make another bid for the White House. The rally was for Republican candidates Trump is backing in Tuesday's elections. Workers are suing Twitter over Elon Musk's plan to eliminate about 3,700 employees at the social media platform. Their lawsuit claims the layoffs are taking place without giving enough notice. The job cuts will amount to about half of Twitter's workforce. China's Xi Jinping met with Germany's Chancellor Olaf Scholz today in Beijing, and he used the occasion to send a message to Vladimir Putin. Xi told Scholz he opposes the use of nuclear force in Europe. Those were his most direct remarks yet on the need to keep Russia's war in Ukraine from escalating. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps would surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are in Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
This month, Bloomberg is live at COP27 in Sharm el-Sheikh, Egypt. Bloomberg Television and Radio will have complete coverage as world leaders, business insiders, and decision makers gather to take action toward achieving the world's collective climate goals.
What are your top 3 priorities?
There is an ability always to find the new and innovative ways to meet the challenge and at the same time take into consideration the pressures that exist.
Special coverage begins November 7th, only on Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. The top names in business are on Bloomberg.
The financial services industry, which is a large part of the UK, is very competitive. But it's not the only one. Health sciences, even technology and fintech are very, very bright stars in the UK.
The market environment is a very challenging one. It's not about blaming the markets. The markets is the same for everyone. And that's exactly how we deal with it.
90% of our clients are indicating we need more guidance. And if they want more guidance, that's why they bring their money to us.
Nobody covers business like Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
All eyes are on the October jobs report.
The unemployment rate needs to rise for inflation to come in.
We may be seeing a Fed that doesn't have to do a whole lot more.
Today, Tom, John, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
To preserve jobs in the long run, we need to kill inflation.
We have a long way to go.
Creating pain in the jobs market is not what we want to do.
Is it worth paying this price to get inflation down?
The October jobs report, today on Bloomberg Television and Radio.
Uncertainty. Uncertainty is the enemy of deal making. And in terms of the markets and what's causing that uncertainty, clearly the Fed is way ahead of the midterm elections. I think if you look at the effect of midterm elections on the markets, the last 16 midterm elections have been followed by up stock markets 6 months and 12 months.
That's the market history from Ralph Schlostein there of Evercore. From New York, let's get straight into this price action. Equity futures up 0.8%. The payrolls report coming in about an hour and 12 minutes from now. All the reopening rumors in China getting more fuel from several reports. Crude higher on crude, 91.39 on WTI, up by 3.65%. In the FX market, euro dollar, a 98 handle, weaker dollar here. Yields creeping higher again, though, on a 10-year by a basis point to about 4.16. If you're looking at a 2-year, through 4.70 in the last couple of days, post-Fed. Right now, 4.75. Call it 4.76 if you want to round up 4 basis points. Going into payrolls, we're looking for 195K. Let's talk about jobs at Credit Suisse.
Yeah, it's not a tech company.
So
it's not
the
a tech
overhaul
austerity.
of the last week, they announced plans of job cuts amounting to about 2,700. Denise Wee, here at Bloomberg, leading the reporting, indicating just moments ago that Credit Suisse is planning a fresh round of job cuts at the global wealth management business starting next week.
On top of the 2,700.
That's what this indicates.
Okay, the 2,700, folks, is 5.2%, which some people would say, I mean, I think Chanel Bassick would say that's sort of a end-of-the-year adjustment in a lot of Wall Street firms, but that's not what this is, John. This is part of this huge reorg.
This adds to dismissals that already started at the investment bank, according to people familiar with the matter. Credit Suisse, a spokesperson, of course, reached out to them, reiterated their plan to cut 2,700 roles, said it's underway, and declined to comment further.
And our allude is maybe there would be more than that. Yeah.
The idea that it's spreading, the job cuts are spreading. I'm not sure on the number.
In the spreading, Warner Brothers Discovery, we don't need to do it right now, but they made clear they are speeding up rapidly. They had synergies move, I believe it was from $3 billion out to $3.5 billion as they move in a tough entertainment
It's a
business
difficult moment to reorg a bank, Tom, in a market like this one. It's never easy, but this is not an easy moment to do it in.
Are you liking the heat wave in New York? 70-something
It's warmer.
degrees?
It's warmer in Europe, too.
Election, Washington, D.C. We'll be there on Monday, 79 degrees, basking in the November glow. Outside the White House is Anne-Marie Horton, and she joins us right now, Bloomberg Washington correspondent. The weather is unusual, and Anne-Marie, I want to open this up as we really begin with you, our election coverage. This midterm is unusual and comes to turnout. Do you have any sense if the turnout will be greater than the stunning number of 2018?
Well, the direction of travel is that we are seeing robust turnout, Tom, not just in early voting, more than 30 million, but also the fact that what the polls are showing is that it could match 2018 or even surpass that. Another interesting point, I was reading through the details of this morning from an analyst group, is the record amount of money ever spent on state and federal elections we are seeing in this midterm election. So there's a lot of money and there's a lot of people getting out the vote. And part of this is, we talked about this yesterday, especially when you look at suburban women who really came out in droves to flip a lot of House seats to Democrats in 2018. They are now very upset with the price of costs of things going up and inflation rates. This is their number one concern now. This is starting to shift, and the polls are showing more than 50% they want to get out and vote, and they say they plan to. So, and it's also warm weather, so it does look like it is setting up for this to be a very high number of turnout of Americans this midterms.
Anne-Marie, the consensus right now is that the Democrats will lose the House. What about the Senate?
Well, it's an interesting question with the Senate because it really depends what poll you look at, right? Because many say it's still a toss-up. If you look at 538, they're saying potentially it looks like they can win this and make it 51-49 Dems. But it's going to be one of the ones that's going to be very, very, very close. And that's really to be expected because right now the Democrats are in control, but laser thin majority, right? So this is going to be something that everyone is going to be focused on because pretty much everyone agrees that the Republicans are going to win the House. They are poised to. You even have some senators coming out talking about what they should do, Democratic senators, in the lame duck session because they think Republicans are going to really win the House. The House, the issue is the numbers. The Senate, it's still a toss-up.
Anne-Marie, how worried are they at the moment that the next governor of New York might be a Republican?
Well, I think they're incredibly worried. Who did we have there yesterday? The Vice President Kamala Harris and former Secretary of State and also presidential Democratic nominee Hillary Clinton going to New York to campaign for current Governor Hochul. This is something you really wouldn't see just days out from a midterm election. They are in deep blue New York. This is something that would be actually quite shocking if she was to lose this race. But Hochul recently said in an interview she felt like she was the underdog. She retracted a bit and said, I feel that way because I want to make sure that every campaign I'm connecting with voters and want to win their vote. But at the same time, what you have is from Representative Zeldin is something that is starting to really resonate with New Yorkers, which is the fact that they do feel like crime is going up. In New York City, you look at some of the MTA numbers, some subway crime is going up some 30%. And this is what is resonating at the moment in New York, on top of the fact that it is just more expensive to live there.
AMH, thank you. Anne-Marie down in Washington, D.C. Tom, if that doesn't speak to the weakness of this party right now, I don't know what does. If you're fighting up here in New York to keep hold of that, You got a problem, haven't you?
Well, there's an upstate, downstate tradition here, and I would play this in, and folks, for our international audience particularly, this is not Hugh Carey, who was an iconic governor of New York with a whole sense of New York City, and, you know, you think of, El D'Amato of Long Island as a Republican. This is Kathy Hochul from Buffalo, and I really wonder how growing up in Western New York as I did, good morning to all that drink Genesee beer. Cream ale's wonderful. Miss Hochul was weaned on Jenny Cream Ale. And the bottom
Why is this
line,
always about booze?
it's not. First of all, Jenny Cream Ale is not booze. It's a beverage of your choice.
Is it a light beer? What
No, it's not like Coors 3.2.
Okay.
Don't you insult.
It's a question.
Please.
No, it's just a question.
The Whaley
just
family would be
wondering.
insulted. The bottom line is the governor running here with all the trauma and how, Cuomo and all that, she's from Buffalo. And that's not really explained by the media right now. And each race is like this. There's nuance in Iowa and everywhere else.
I'm just pleased as a bottom line. Do you remember the lieutenant governor used to come on this program with us and then
She
became
did.
governor and stopped speaking?
What
was that about?
I don't know. Speaking of beverages, this is great. I don't know if you know this.
what's
On
that?
radio, you can't see this, but I've been trying this. This is Tang Zero.
Yeah.
And I'm trying it out.
Came
It's
into the
actually
studio
pretty
this
good.
morning. You weren't here, Lisa.
Tang
You
Zero.
avoid these chats. And he says, Tang sent me the new Tang Zero. And I looked at him and I said, are you serious?
Yes, I am.
Are you serious?
He actually has
it's got the orange glow
on his counter.
I mean,
You actually have a container of Tang on your counter at home.
I do, yes.
I didn't realize that until
Tang Zero.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Four-day losing streak on the S&P 500, going into payrolls, trying to bounce, trying to rally, up 0.7% on the S&P, up 0.75% on the Nasdaq. On the week through Thursday, the S&P 500 negative by more than 4%, the Nasdaq down by more than 7 percentage points. Potentially, if we close there, the worst week on the Nasdaq 100 going all the way back to January of this year. That's the equity story, the pain in the bond market. That's been a story of 2022. Your 2s, 10s and 30s year yields look like this. A 2-year just short of 475, the highest we've seen since 2007. The difference between 2s and 10s, the most negative since 1982. Tom, that difference right now, in and around negative 60 basis points.
Can we say in honor of the chairman of the Federal Reserve System, this is all moving very, very quickly? That would be my statement over these chaotic 3 days.
Well, Tom, we all wondered whether he could open the door to a step down in interest rate hikes without prematurely triggering an easing of financial conditions. And if that was the question going into the news conference, I think he answered that. He can. He leaned very hard into this idea that terminal rate is going to be higher. And we can talk about that in just a moment. What else do you have? I want to talk about this in the commodity market. If you open up the commodity screen on a Bloomberg terminal, if you have access, you'll see a ton of green. Here's some of it right now. WTI, Brent, copper, absolutely surging here. The why, Tom? Let's do the why. There is a conversation this week, the rumor mill, about China reopening. Yes. There was a rumor earlier this week that the government had put together a committee to assess dropping COVID zero. No confirmation of that whatsoever. But you start to get two reports, one from Bloomberg, one from Reuters. One from Bloomberg on opening up travel just a little bit more by dropping some of the penalties that they levy on airlines if they bring COVID into the country. And another from Reuters about maybe shortening the quarantine, Tom. And that just fuels the rumor mill. And I think it's fueling this commodity market this morning too.
I got Brent crude, and you've got it there, John, on radio, 97.86, up 3.4%. But we got a major folks pop. John, it is an outrage that John Farrow from the city is quoting Chicago Copper.
If you noticed, I didn't quote it.
Folks, let's get this straight.
I know.
To keep Farrow on the straight and narrow to 8:30, and Tom Perselli will understand. You've got to understand, folks, there's two ways to quote copper, and on surveillance we do that. We look at LME
there's
copper.
One way to quote copper.
Thank you.
That ain't it.
We do London LME copper, 7,000 something, and then we have $3.58 Chicago.
This is for the third time in 24 hours. I'm sorry, London. Forgive me.
I know.
That's the cross-asset price action. Let's get you some single names, some movers. We can do that with Bramo. Hey, Lisa.
Hey, John. I will follow up, though, on the story that you were talking about with China and some of the rumors that have really fueled some of the rally. But first, I want to talk about earnings. What have we seen this earnings season as almost all companies, about 87% of market capitalization in the S&P 500 have reported? If you disappoint, you get penalized heavily. If you disappoint on the forward forecast, even more so. The examples today are PayPal down almost 7%, 6.6%, ahead of market trading after coming out with disappointing outlooks with expectations of a potential slowdown in the business. Twilio, a software provider, down 26% after their disappointment and after a forward forecast. And Kratos Defense and Security Solutions, which is not in the tech sector as much, down more than 10% after talking about supply chain disruptions and issues with the labor market. These are all different aspects of the same story that we keep telling, right? Software, hardware, tech in general getting hammered. How much is that a broader story? And then, of course, the areas that are more affected by labor shortages as well as some of the supply chain disruptions still feeling that pain. So how much is that a broader story and how much is that idiosyncratic for specific areas? On the flip side, to John's point about some of these rumors, in China, we are seeing a massive rally once again in some of these Chinese ADRs, the stocks of Chinese companies. Alibaba shares surging about 9.5% ahead of the market. JD.com, which is an online commerce site, up 9.3%. Yum China up 6.8%. Tom, how much can we really buy into these rumors, especially as Chinese authorities are trying to push back and saying there's no change. There's absolutely no change. And yet I do wonder what the signal is that Xi Jinping is actually being more outward looking, is going to places, is meeting with foreign leaders. Is that alone enough of some sort of statement in addition to all of the supports percolating out?
We'll have to see. The stories percolate out, and let's remember Sunday evening, folks, eventful. Look for Asian coverage on Bloomberg Radio and Bloomberg TV, because I'm sorry, it could be really eventful from the bank, at least into Sunday. Look at PayPal, though, Lisa. You know, you talk about the tech wreck. It's down 74% from the moonshot of the bull market.
We talk about the bubble and then the bursting. How much further does it have to go? And is there a broader ramification, or is this really an isolated area that got bid up during extraordinary times?
Right now, let's speed to Tom Parcelli, Chief U.S. Economist, RBC Capital Markets. Tom, I got a 1 hour conversation to squeeze in here. Give me the wage benefit dynamic right now that you and RBC see.
Yeah, look, things are slowing down. But you know, Tom, as I'm sure you appreciate, the moment you say things are slowing down, I think people just default to like this this collapse. I mean, that's not what we're talking about. I don't think that's where we are. I mean, we're looking for the sort of the nuances in the data, and the nuances are that wages are slowing. I've said this many times on this call. You know, I prefer average weekly earnings. I think it's just a much more complete measure of wage dynamics. And if you want to look at that like on a 6-month percent change basis, which I think is the right way of looking at it, you know, just because you can strip out the year-on-year stuff. Right. Year-on-year is very wonky right now. So if you look at the 6-month percent change, it has slowed down. I mean, you're running at around a 3.5% pace. You're running as high as a 5.5% pace. So the wage dynamic is slowing down. But again, I think this is going to be a very slow grind into sort of this weak labor market. I mean, it's something we've been saying for a long time now.
How does Jerome Powell adjust to the slow grind you predict?
Yeah, so right now, I think it's a great question, because I think there are two ways or two boxes that they need to check, right? The first box, of course, is inflation. They need to see inflation slow down. He was very vague. He was asked specifically what he wants to see, and he was pretty vague about it. I'm sort of sympathetic to that, I guess, on some level. But I think by the time we get to the March meeting, I think inflation will have slowed down enough to basically put this hiking cycle on pause. So call it February, March, Fed pauses. The next box that needs to be checked, and this is for the people that are sort of desperate for the pivot. And as I'm telling you, I hate this word. I've grown to hate the word pivot. It's just really, makes me want to jump out of my skin. But to get to the real pivot where he's reversing course, the next box you need to check is labor. And more specifically, you need to get to or near job losses. And I think that's probably waiting for us sometime around the middle of the year. And I think you check that box off, and I think that's when the Fed reverses course.
Tom, what could you be getting wrong? Because so far we're not seeing it at all in terms of a slowdown. And each surprise, inflationary-wise, around the world has surprised to the upside relative to expectations.
Yeah, definitely, Lisa. So, you know, what can happen between, again, you know, it's not like we're looking for job losses now, just to be clear. I mean, this is something we think is, you know, at least 6 months away. So what could go wrong between now and the next 6 months where the labor backdrop really hasn't been turned a little softer? You know, if I knew, I probably wouldn't get the call wrong. So I would say that the reality is the consumer is still sitting on, in the aggregate, Larry, I want to be very clear on that point. In the aggregate, the consumer is still sitting on a mountain of cash. There's obviously a lot of people that are completely tapped out. The consumer still has access to credit. You know, those two things can help buoy the consumer. And if the consumer continues to go down that path, then, you know, you could certainly see a dynamic where that mitigates any of the softness. But Lisa, again, just so we're, again, you're asking me to sort of think about things that can go wrong, but relative to my call, but just so we're clear on my call, you know, I've said this for a while now. If you look at, so I like to look at net value add for corporate business. It's think of it as like sort of a proxy for profits in simple terms. It comes from the NIPA accounts, right, from the GDP accounts. When you look at that measure, this net value add corporations, in the first half of the year, it was running at around 11 or 12% pace, first half of the year. Great. That's in nominal terms. Yeah. In real terms, it was down 2%. It was minus 2%. Think about what that means. The only reason why you actually saw net value add, this proxy for profits, actually in positive territory is because companies were able to inflate their way to profits.
And
Think
Tom,
about what that means.
I get that
Wait,
point. I get that point. That basically. Go ahead.
But sorry, let me just finish the whole idea. So what that means is that the volume of stuff is down, right? That's what it means when you look at real profits that were negative territory. That means the volume of stuff was down. So what's happened thus far in here in the second half of the year? Well, in the second half of the year, the volume of stuff continues to actually be down. So what do companies do to defend profits? Well, the classic way is to basically go after labor. So that's what we think is waiting for us. Again, I don't think it's get pernicious, but I think that's the path. Sorry, Lisa, but you were going to say.
Just really quickly, Tom, the Fed has been very clear that the balance of risks is inflation getting entrenched. And right now, it still has to be that, especially with the surprise. Just in 20 seconds, 30 seconds. Why do you disagree?
This is not going to become entrenched?
That's not the main risk that we're facing.
Yeah, look, I think that there's a lot of disinflation in the pipeline, right? I mean, I don't think that's not a guess at this point. I think the Fed has to say this. Because the moment they don't say that is the moment that they let financial conditions ease, and that's the last thing they want to do. Jay Powell will be the last person to acknowledge that labor has turned and that inflation is in a better place. And I have nothing but sympathy for that view. But that's at odds with what we see in the pipeline from an inflation perspective.
Hey, Tom, we've got to go. Wonderful as always. Tom Porcelli there of RBC Capital Markets going into payrolls. What Tom is saying is there is a difference between what this Fed wants to signal and what it actually thinks. And this is a question we're asking. When you look at the labor market right now, we see cracks all over the place. Don't see it in the data. Might see it later. Might see it in 50 minutes. Don't see it yet. Not in a big way. When we look at the inflation stuff, you see it in freight, Tom, you can see it elsewhere. We've seen it in commodities, select parts of it. Haven't seen it in headline inflation just yet.
I'm going to defend Richard Clarida. It is a single mandate message. They are fixated, as is Joe Biden and Donald Trump, on one thing, inflation.
Some select senators have a problem with that, Tom.
Yeah.
They quoted, they cited that line.
Round it up, $98 Brent. It's not going away.
Ronnie Krosner's coming up in a little bit. 8:15 Eastern time. We are 50 minutes away, call it 49 minutes away, from a payrolls report in America. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Oprah Winfrey has thrown her endorsement to Democrat John Fetterman in the Pennsylvania U.S. Senate race. Fetterman is trying to win a tight contest against Mehmet Oz, the Republican who is one of Oprah's former proteges. Oz is a celebrity doctor whose rise to fame began as a frequent guest on Winfrey's talk show. He later hosted his own successful program. A warning from European Central Bank President Christine Lagarde. She says interest rates may need to be raised to restrictive levels back to get inflation back down to 2%. And the ECB has raised borrowing costs by 2% in 3 months. Lagarde says the bank may have to take them to a point where they act as a brake on the economy. Apple could be shifting from its deep reliance on China. Sources tell Bloomberg the company's Taiwanese contract manufacturer, Petegra, has begun assembling the latest iPhone 14 model in India. Now, that would make Pegatron the second Apple supplier to produce a smartphone in the country. The news comes after Apple's key manufacturing hub in China, operated by Foxconn, was placed under COVID lockdowns by authorities. And Bloomberg's learned that billionaire Jeff Bezos may take an offer from the National Football League's Washington Commanders. And music mogul Jay-Z, well, he could be an investor. The owners of the team, Dan and Tanya Snyder, say they're exploring options, including a sale. The Snyders are facing increasing pressure to step down. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a win and
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
No one covers the world like Bloomberg.
The writing's on the wall for the Bank of England. Just Stop Oil has spray painted the front door.
Recession in Europe, UK, and possibly the US.
Brazilians are out in full force celebrating the election victory of former President Lula da Silva.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority. The top names in business are on Bloomberg.
This was not a solvency issue at all for the pension system. It was a liquidity issue. So a liquidity problem had to be managed.
Nobody covers business like Bloomberg, your global business authority.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
The Fed's saying we've been getting this so wrong for so long on inflation. We got to see the numbers. We can't anticipate the numbers. The Fed's still telling us we'll keep raising rates. Global growth is slowing. Risk aversion is pervasive. You're going to buy the dollar.
That's what people have been doing all year. That was Daramet there, the HSBC head of research and FX strategy at HSBC. Your market looks like this in the equity market. Futures are up by 0.7%. The jobs number drops at 8:30 Eastern, so that's about 42 minutes from now. Yields are higher by about a basis point on a 10-year. On the front end too. Look at this on a 2-year. Yields up 4 basis points. 4.75 on a 2-year.
A true 4.75, no roundup.
Where were we 12 months ago? I'll tell you. 40 basis points. 40 basis points 12 months ago. 4.75 this morning on a 2-year.
Smartest guy in the block. You want a book to read this week? We can start with Fooled by Randomness, Nassim Taleb. He has one of the quotes of the year. The gravity is back in physics.
In a big way.
That's what you're talking about with a 2-year move.
Need to talk about the commodity market as well. WTI 91, Brent 97, and I tell you, Tom, pushing 98 now. Brent crude up by more than 3% on the session. The rumor mill around China getting some real fuel in the last day or so.
No
about
pun
reopening.
intended. I like that. Very good. You know, that seemed like the humor of Will Kennedy there.
No, I planned this stuff.
Getting some real petrol.
These
Will
lines
Kennedy joins us now on hydrocarbons, and this is something all of you care about, including those towards a midterm election as well. Will, is it feasible at Brent 97, rounded up to 98, that we get $100 a barrel by Election Day Tuesday? Are we moving that fast?
I think it would take another big headline out of China to get us there, or something else, some kind of supply disruption. But it's clear that $100 is definitely back in the sights of the market. And as John said, this is being driven by China. When we look at the global oil market, the one source of weakness that has been consistent this year is China, where lockdowns have kept mobility under control, so that means less driving, less flying. If that changes, that injects probably several 100,000 barrels of extra demand, and it will tighten the market considerably.
And Will, an apology on the part of Team Surveillance. It was completely my fault. We quoted Chicago Copper earlier instead of LME. Farrell almost walked off the set in a tantrum. Will, it will never happen again. I'm sorry. But are they linked together? Is copper and the regular commodity lift, is it linked with Brent and China to $100 a barrel?
I mean, it's all part of the same picture. More than half of copper demand comes from China. It's the ultimate bellwether of the industrial economy, as everyone always says. A China recovery would be very good for copper prices. That said, it's more of an input into China's industrial economy, which has not been as affected by lockdowns as the movement of people around China and oil demand.
Well, it's November. We're tracking the weather as much as we are markets. The weather's been warm. People feel better. It still is a long winter ahead. How much would a China reopening take energy away from Europe, away from the U.S. at a time when prices are the foremost concern?
You're right to point towards gas as well. I mean, one of the reasons that Europe's been able to fill its gas supply, fill its stockpiles, one of the reasons why gas prices have fallen back a bit is because China's gas demand has been subdued. And of course, a stronger Chinese economy could change that quite quickly, Lisa. So yes, it's definitely something for people to watch on the gas side as well as the oil side. It could feed through into the whole energy complex. And it would only take a spell of colder weather in Europe before the narrative on gas prices change. One other thing to say about the energy crunch in Europe is we got another dreadful set of figures from France overnight about just how constrained its nuclear production will be. They're missing earlier targets. That sent gas prices higher today. A real sign that for all the good news we've had on gas and energy crunch in Europe, the winter is a long one, as you say, and we're nowhere out of the woods yet.
It's such a confusing picture with Europe because it's hard to understand or really give generalizations to where different countries get their energy sources. Natural gas in France, the nuclear plants. Is there overlap and substantial overlap in terms of the sources of natural gas for China and for, say, Germany or the other major economies?
Not Germany yet, because Germany, one of the problems that Germany's had in this gas crunch is that it didn't have the capacity to import LNG. But one thing we are seeing is the emergence of a global LNG market. That's a trend that's been happening for years. More LNG is traded on a spot basis, like the oil market, as opposed to long-term contracts. You see traders coming into the market. You see cargoes being arbitraged between Europe and Asia. So that's a world that is changing, and that's a world where energy events in one part of the world, the energy crunch in Europe, can have an impact on the cost of energy in Japan and China, and vice versa.
Will, an unfair question, but it's Unfair Friday. Do you and your team model that if China comes back to some form of GDP, call it 5% as a guesstimate, that we revisit 122.01 Brent crude?
I don't think we would model that. I do think that what I would say is there's a potentially very bullish mix here. We've talked about China. The other thing that we need to talk about is the impact of Russian sanctions, price cap. That's a big focus of the market right now. In early December, the European Union will stop buying Russian crude, and that Russian crude needs to find a home somewhere else. Now, it has been selling a lot more oil to India and China, but it's a real question whether those markets can absorb all that crude, and whether the logistical, the financial, the insurance aspects of that, finding the right ships, all of that can happen, or whether there are going to be huge snarl-ups and some of that Russian crude gets stranded in Russia. Now, you put that together with a China reopening, you put that together with pretty resilient demand, frankly, in the rest of the world, and you get a very bullish mix. One other thing I would say on demand, people talk about a recession and what it would do to oil. It takes a very, very deep recession to cut oil demand. It happened in the global financial crisis, sure, but most recessions just see demand grow at a slower rate. So I don't think people should necessarily assume that if we get some kind of economic slowdown in the wider world outside China, that definitely translates into lower demand. It could prove a pretty bullish winter if some of these things come together, Tom.
Hey, Will, wonderful coverage from you and the team, as always. Will Kennedy there in London. 91.50 on WTI, crude up by close to 4% on the session now. Brent crude right now, close to 98, 97.90, up by 3.4%. Every single line of that commodity market, Tom, this morning, basically every single line is rallying.
Just since I was busting your chops 7 minutes ago on copper, it's lifted out to new recovery highs. Copper to 79.13 LME, and in Chicago 360.25. You got to quote both numbers.
Do you?
There's surveillance.
I'm just used to only quoting one.
Well, no, I mean, my expertise on this, Lisa, is that if you're in the Dorchester Hotel at the mining conference with your senior executive producer, she asks for the umbrella in the cocktail that's gold and black in honor of Purdue. That's what you do at the LME conference.
LME Week is very cool.
LME Week was very cool. We observed
road
it.
trip.
I don't think it's as cool as it used to be.
Oh no, it's changed absolutely. Big time, it's changed.
Well, because you can't drink
But
as much.
you can't get a drink without an umbrella.
What do you mean, you?
Yeah, I'm just saying, you is in general.
It's a general you.
You cannot, it's a general you.
Royal you.
Payroll is 34 minutes away. This is Bloomberg.
Should we anticipate that you will have regulations clarifying what the SEC is going to do on cryptocurrencies and related kinds of things in the near future?
It's pretty clear that many of these tokens may be securities. What we've asked the trading platforms, the lending platforms, the other various venues to come in, to work with us, to get registered under the securities laws, because if a platform has 50 or some of them 500 tokens on their platform, probabilities are they're not all non-securities.
Now, there's another issue that has arisen, which is called gamification, which is to say people are making a game out of trying to buy stocks. Are you worried about this phenomenon?
We live in the 2020s in a new digital age where applications on our phones can use massive amount of data and then predict our behavior. What do we do when the digital algorithms are maximizing for the company's revenues rather than our returns? And so we're trying to think that through. It's not just gamification, it's a little bit more than that. It's whether there's a conflict between the app and our investment returns.
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions. November 8th, as Americans decide the future of Congress and state legislatures, Bloomberg will be live in Washington, D.C. to cover the results as they break and provide insight about what it means for the country.
We're in a divided country, and these are really close elections. We take a look at what the races could mean for Wall Street.
Special election night coverage starts at 8 p.m. on Bloomberg Television and Radio. And tune into Surveillance live from D.C. at 6 a.m. on Wednesday for the latest overnight. This is Bloomberg.
I wouldn't read too much into what the central banks are saying right now.
Some doubts are creeping in, and I think that's where we are. This is really very different from where the Fed is right now.
The Fed's saying we've been getting this so wrong for so long on inflation. We got to see the numbers.
The problem is we don't really know where neutral rates are.
There is the potential that there will be more of a focus on the lag effects and a slower pace of rate hikes from here on out.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. We welcome you on Jobs Day in 29 minutes. And John, this is a Jobs Day, which is about 3 days. A Fed press conference, the stunning 2-year recession announcement out of the United Kingdom, and then on to some real data today. It's going to be amazing to see what Jerome Powell thinks of it.
It's been 2 hours. We haven't said it once. Is bad news good news today?
Oh, you're killing
Or is
me.
good news bad news? It's been 2 hours. We didn't mention it once.
You're just trying to trigger us. You know, he triggered you
I'm not
with
trying
the
to
end
trigger
zone.
you.
Well, I mean, honestly,
I've heard this week,
Okay.
end zone, the Dow, multiple
exactly.
times.
You're like, I'm done.
What's the end zone?
Yeah, The end exactly.
In English
zone.
football.
Wait,
Good news, bad news?
195k is the estimate. Chairman Powell's on a mission, Tom, to convince this market that the terminal rate's going to go higher. Even if they slow down, they're going to do more.
Are the vigilantes out there? And we're going to do this. Is going to be a little different, folks. We're doing the Jobs Day, and we'll do Michael McKee with all of his expertise, but we're going to fold the markets in the whole way. Are the vigilantes out today? The China vigilantes, the real yield vigilantes, the copper vigilantes, they're out today for Jobs Day.
Well, let's talk about crude and let's talk about China. The rumor mill in overdrive.
We just had a 98 print on Brent.
All week about
98.
China reopening, and it gets more fuel today. 98 on Brent, WTI just short of 92. We're up 4% on WTI crude today. And Tom, you've asked all year, imagine what this commodity market looks like if China came back online. Well, we're starting to price it in slowly. Let's see if we get any kind of confirmation from China whatsoever, because so far we haven't had much at all.
And that, Lisa, this is critical. That's a difference. Ed Morse earlier this week saying, no, we're not going to go to 120. Lots of demand dynamics there and supply dynamics as well. And Christian Malik over at JP Morgan says, baloney, China, Pacific Rim, up if they get the demand back.
And if that happens, what does that do to the global economy? What does that do to where end rates have to end? It's not just 2-year yields that are the highest since 2007. If you take a look over in Germany, 2-year yields there are the highest going back, or touch
Frame
the
that,
highest
John,
going back to
2.14%. What does that
2008.
mean?
But just this comes after ECB's Christine Lagarde actually came out and said they might actually have to have higher rates even still, echoing what Jay Powell said because of this concern about inflation.
Lisa, to your point, this started in Jackson Hole. At the end of August, you heard from an ECB executive, Isabel Schnabel. You heard from Chairman Powell, and they were both telling you the same thing. They're willing to cause pain. And in fact, the ECB is going a step further because they face the very near real reality of rolling into recession. And they're telling you they will keep hiking interest rates in that recession. So, Tom, it's different to what we've experienced before. And I keep asking the question for 2023. The number one question for 2023, if you expect economic weakness, do you expect the Fed to stand idly by and watch it play out? And that's going to be difficult.
Before we get to the data, we've got to look at the present news, which is tech austerity. Nick Turner with a great phrase over at Bloomberg Tech. But guys, I want to talk about the scariness, the layoffs, the Twitter thing, and all that. And is that separate and discrete from the job economy, or is it portend a path to 5% unemployment? I don't know the answer to that.
Let's strip out Twitter. It's its own beast. We can pick up on all the others, the chip makers, Qualcomm freezing hiring, Intel cutting jobs, cutting spending, all the above. You've seen that at Amazon. You've seen layoffs at Lyft, layoffs at Stripe. That was announced yesterday. We know that's where the excess has been in the tech sector. Not just the last couple of years, the last decade plus. So you know you need to unwind some of that excess. You're asking the right question. Is this a narrow story, or is it going to become a broader problem? And that's part of the conversation right now.
4.75% 2-year yield. That's the data point of the morning.
475, just Unreal. 40 basis points 12 months ago.
Yeah.
40 basis points 12 months ago.
That's like, CD. You could like get a 2-year CD and you're like, okay.
Get a 12-month
You
T-bill.
do a data check? I'm trying
going
to
to do
get you
one
into,
right now.
Do the,
What's wrong with you?
Dow futures are up 181. Okay, there's your cue.
That's how you think I'm going to get the data check. Futures look like this on the S&P. We're 25 minutes away from the payrolls report. Futures are up 0.7%. We do the survey here at Bloomberg. The median, 195K. The previous number, 263. Unemployment, Tom, expected to tick a little higher from 3.5% to 3.6.
We had a briefing now. We go to the markets. Nadia Lovell joins us, senior U.S. equity strategist. Nadia, we've ignored this morning at UBS. Can you reaffirm an equity call for next year, or is the labor economy, the Fed economy so uncertain you just really can't get out to say June of 2023? What's the call?
I think it's going to be difficult, but I think our message, Tom, has been quite consistent. We've been seeing that this market is going to be choppier and lower for longer because it will be determined by how high the Fed go and how long it stays there. I think what the market has been trying to suss out is whether we end up in a recession or not. And as we've been discussing this morning, the fixed income market does point to a high probability of recession. You've been talking about the deeply inverted 2-10 curve, but I think also, more importantly, watching that 3-month 10-year curve, which recently briefly inverted, and that tends to be a better indication of recession. And so it's just really difficult to see how this market bottoms before that if we do end up in a recession. It's just not typical historical trends. Market tends to bottom in a recession, not before recession. Even Chairman Powell this week admitted that the path to a softest language is quite narrow. And so if we think that, if that happens, we think that we've lowered our outlook for the S&P 500 to 3,700 for June of 2023. There's risk to the downside. We see an earnings recession. I think it's just really difficult to be bullish in this market when you have a Fed that is laser focused on burning growth to suffocate inflation.
We've been talking all morning, Nadia, about the real rate. We've been talking all morning about 2-year yields at 4.75%. And when you look at it on a relative basis with earnings yield in the S&P 500, it's looking more and more attractive. At what point have we fully priced in that reality versus really have to look at that real rate, that gravity that Tom talks about, as really driving further weakness ahead?
We think that there is further weakness ahead, and as you noted, the fixed income market is looking more and more attractive. The equity risk premium has come in because of that. And so we do see more headwinds ahead to the market from a rate standpoint and valuation potentially coming in further. Right now you just have the forward PE in line with historical average. If we do end up in sort of a plain vanilla recession, that's likely going to put more downward pressure on a forward PE multiple. So we think that that's going to also keep a cap on the market. We don't think that all of it is behind us. Most of it is behind us, but there's still more to come.
Nadia, what part of the market do you think is further along in the adjustment process? And which part of the market would you lean into with that in mind?
I think that obviously parts of housing is further along in that adjustment process. We have the mortgage rate now through 7%. And so that's going to also have larger implications to other sectors. And so we still think that there's some further weakness to come in consumer discretionary. Those markets that we continue to prefer here is the energy market. Of course, you've been talking this morning about the upward pressure to oil prices. We've been saying for quite some time that we think that Brent is going to get to $110. There's even risk to the upside now, especially if China comes back online. And then also the defensive sectors, we could continue to favor healthcare and consumer staples.
Nadia, if China comes back online, and we've had this discussion now for weeks, if they reopen, if they even give us a real hint that that's where this is going, is that good or bad news for the US market, given the Fed's going to have to lean harder into that?
It's good news for energy, maybe not so good news for the broader market because, yes, we know that energy has been a source of inflation and that filters through the entire economy. And so that's going to make the Fed's job a little bit tougher. Right now we're thinking that the terminal rates peaks at 5.25%, but it could push higher, if you see the commodity complex really rallies on China coming back online, and that's going to make the Fed's job a lot more tougher. So you could get to a terminal rate that's even closer to 6% if inflation does not abate.
Nadia, we're almost done with earnings season. What's your biggest takeaway so far?
I mean, so far it's been a quite underwhelming earnings season, quite disappointing. I mean, we've seen some high-profile misses, but what has continued to be clear to us that a slowdown is happening, particularly in tech. I mean, we've known for some time that there's been a slowdown in PCs and smartphone. That is expanding beyond that and also to data centers and gaming. We're seeing a slowdown in cloud computing as well, and some of the services are just pointing to weakness in overall tech. I think in terms of the consumer still remains fairly resilient, but it's becoming even clearer and clearer that spending continue to shift away from goods and towards services. And so we also, the dollar remains a key headwind here. I mean, we've heard it from a lot of multinational companies, and that's something that we continue to watch closely, especially as the Fed remains the most hawkish central bank globally, and other central plans that terminal rates could potentially come down while our terminal rate is looking to risk to the upside.
That got highlighted this week, that's for sure. Nadia, thank you. Nadia Lovell there of UBS Global Wealth Management. We saw that in the space of 24 hours. Wednesday, the Fed Chair Jay Powell leaning into the idea that we could have a higher terminal rate. And then you had Governor Bailey, Tom, trying to push back against that idea that we'd have a higher terminal rate in the United Kingdom.
That's why this
bizarre.
And I may be off on this. I mean, I defer to our good guests, but to me, it's almost a 3-day jobs report. It's not about 8:30 this morning. It's about the continuum since Powell's stunned at the back end of that press conference.
So a 3-day news conference, let's say.
Yeah, I could go.
And then it's on to next week for CPI.
Well, yeah, and to your point, CPI. I mean, could it be a bombshell? I guess so. I don't know.
I would say it's a 12-month, jobs report. It's a 2-year jobs report. I mean, this is basically this rolling story that we keep getting wrong and surprised by.
What did Binky say yesterday?
It is.
Binky corrected me, and he said that it wasn't a continuation of the Jackson Hole speech in late August. He said it was a continuation of the March Federal Reserve meeting, and it's been going on for 8 months since then. Do you know how painful it feels to be that bullish on this market and see this Fed just eat it up,
eviscerate it
every single time he speaks at the moment?
What was it that you said? What was the 2-year yield 12 months ago?
40 basis
40
points.
basis
And then
points.
if you get Will Kennedy's
Regime
markets,
change.
you come right back with a China opening.
Yeah.
It pushes completely
You've
against
got another problem. Crude right now, just short of 98 on Brent, 91.50 on WTI. Futures just about positive, 0.7%, and yields higher, 4.75 on a 2-year. Payrolls, 20 minutes away.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The monthly U.S. jobs report out in a few minutes from now, and the question is whether the labor market is cooling enough for the Fed. A Bloomberg survey says employers added 195,000 jobs in October, and it sees a jobless rate rising slightly to 3.6%. Slower growth in employment and wages would support the expectation that the Fed can downshift to a 50 basis point rate hike next month. Donald Trump has sent the strongest signal yet that he plans to run again in 2024. At a rally in Iowa, the former president said, quote, he is very, 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 very probably will make another bid for the White House. Well, the rally was for Republican candidate Trump is backing in Tuesday's elections. Workers are suing Twitter over Elon Musk's plan to eliminate about 3,700 employees at the social media platform. Their lawsuit claims the layoffs are taking place without giving enough notice. The job cuts will amount to about half of Twitter's workforce. And a big sale for Airbus. China Aviation Supplies has agreed to buy 140 of the European plane makers' jets. The list price is about $17 billion, although discounts are usually given for big orders. Most of the planes are A320 single-aisle aircrafts. The announcement was made while German Chancellor Olaf Scholz was on a visit to Beijing. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
This month, Bloomberg is live at COP27 in Sharm el-Sheikh, Egypt. Bloomberg Television and Radio will have complete coverage as world leaders, business insiders, and decision makers gather to take action toward achieving the world's collective climate goals.
What are your top 3 priorities?
There is an ability always to find the new and innovative ways to meet the challenge and at the same time take into consideration the pressures that exist.
Special coverage begins November 7th, only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The top names in business are on Bloomberg.
The financial services industry, which is a large part of the UK, is very competitive. But it's not the only one. Health sciences, even technology and fintech are very, very bright stars in the UK.
The market environment is a very challenging one. It's not about blaming the markets. The markets is the same for everyone. And that's exactly how we deal with it.
90% of our clients are indicating we need more guidance. And if they want more guidance, that's why they bring their money to us.
Nobody covers business like Bloomberg, your global business authority.
So there's just a lot more momentum in the U.S. economy. Europe and the U.K. are dealing with a much bigger rise in energy prices, and they have a war on their doorstep. We don't think the unemployment rate's going to rise soon.
Dean Mackey there of Point72, the chief economist, and Tom, I think he hinted at modelling maybe what Aaron Judge to Queens would look like.
No, he did not.
To the economy.
He ran away.
Did he deny it?
He ran away. He was like, please.
I could see Steve Cohen's shadow behind him.
Yes.
And Steve was just off to the right
Seriously,
side of the camera.
Bramo, don't ruin a good story. Futures up 0.6% on the S&P. Payroll's about 12 minutes away. We're looking for 195k. Equities up, yields higher by almost a basis point on a 10-year, 415 on 10s. If you just check out what's happening at the front end of the curve, and we've been doing that all morning, just to see the 2-year at 475, Tom, and now pushing 476 is quite something. We haven't seen these numbers since 07.
Yeah, it's interesting to say the least. And again, we're going to keep you in with the markets here as we move to this jobs report. Right now, when he's at Brown University, he would sit in the coffee houses of Providence and listen to all sorts of tasteful folk acts like Beveridge, Oken, and Taylor. Joining us now, Randall Krosner, professor of economics at Booth School, Chicago, and of course, former Fed governor. Randy, there's the chairman of the Fed citing in one sentence Arthur Oken, Beveridge of the London School of Economics, and I'm going to drag in the wonderful John Taylor of Stanford University as well. In this job economy that you confront in 10 minutes, does theory matter anymore, or are we making it up as we go?
No, I think theory still matters a bit, but this is a little bit unusual, let's say. We haven't seen the Fed raise rates so rapidly before. We haven't had coronavirus economy, and we haven't had inflation like this for 40 years. So I think theory still helps, but the data may be a little different than, and the underlying structure of the economy may be a little different than 40 years ago.
Let's go to your wheelhouse, Newtonian calculus and its use in finance. What is the rate of change in the second derivative we're observing right now, the rate of change of the rate of change? What do they signal to you?
So I think what the Fed is looking for is really waiting to see whether the labor market is going to crack and find some cracks in the labor market. So far, the labor market has been very strong, really continue to create a lot of jobs, continue to have low unemployment rate, continuing to still have a lot of job openings relative to the number of unemployed people. And I think what the Fed will be looking for is some impact of its policies on the labor market. We've seen it in the housing market. The markets clearly now have gotten it that the Fed's going to be raising rates probably into the fives. That's why the 2 years at 4.75 where it is, and so that's why the job market now and the one that'll come next month will be so important for what the Fed does in December.
Randy, I want to pick up on that, what you just said there. The market has finally gotten it, that it took them a while, but they seems to have really received the message that the Fed is putting out there, that Fed Chair Jay Powell is putting out there. Is the message that rates are going to be above 5% for the bulk of next year? Is that the correct message as correctly being priced into the markets?
I think that's the reasonable likelihood. Now, obviously, how far, whether they will go above 5% and how far above will depend on labor market numbers now, next month, the inflation reports. But I think we're very likely to get probably 50 basis points at the next meeting, and then a continued rise through at least the first quarter of next year that'll get us to a 5 handle. So I think, and as I've been telling you guys for a while, I think they're going to hold with a 5 handle through much of next year.
So how do we see this in the labor market? Because we're not expecting necessarily see it on the headline number. Perhaps we'll see it in some of the wages. But can you talk about where you see the layoffs happening? Do you think it is just going to be a tech-centric in some of these isolated areas, or do you think it's going to be a broader swath of layoffs that we'll start feeling perhaps by the second quarter of next year?
I think that's right. I think it will be broader. Right now the Fed is projecting a peak unemployment rate of 4.4%. That seems much too sanguine to me. If they really want to bring inflation down relatively rapidly, I think it's going to be very hard to have the unemployment rate just go up to 4.4%, because that's not much beyond where they see kind of the long run so-called natural rate level being. We're going to get, Jay Powell has talked about pain. That means that there's going to be, I think, a higher unemployment rate, certainly with getting into the 5s and maybe even to the 6s. Although relative to previous slowdowns and recessions, that's still pretty good, but it certainly is a much higher unemployment rate.
Hey, Randy, wonderful to have you with us. Randy's going to stick around and break down the number when it drops. Randy Krosner there, formerly of the Federal Reserve. We are about 7 minutes away from the Fed decision. The number we're looking for is 193 now. That's changed in the last couple of minutes, so someone got in a late estimate to our survey. The median's 193. We're down from 263 in the previous month. That's the estimate relative to the prior number. Mike McKee, sitting down pretty late this morning, Mike, for this jobs number. What are you anticipating?
Well, the whisper number's higher. The whisper number's like 238. So I think we're looking at the possibility of an upside surprise, and that's what everybody's going to be concerned about. If we get a low number, people will be happy because, as Randy just said, it would show the Fed is having an impact. But if we get a high number, then it's like, oh, the Fed has to do more work and we better reprice again.
You're so good at the mathiness and the data of this, you and Alec Tanzi. Who comes up with a whisper number?
Well, it's actually, there's sort of two. There's the sort of social media one that goes around, but Bloomberg has an actual whisper number thing.
Bloomberg has an actual whisper? I did not know this.
WHIS Go, and people
you can enter,
on the Bloomberg can enter your own number. So if you have a number you want to put in there,
I can do this?
You can do this.
Wow.
Well, Randy, and I know that you're here listening to this, and if the whisper is correct, and we do get a higher than expected number, does that change where you see the Fed going in terms of how much they have to do to really undermine some of the momentum?
So they're going to keep going until they see some slowdown in the labor market. And if that means, if we get a really strong number this month, if we get a really strong number a month from now, inflation is still not coming down, they're going to be moving. They might even move 75 rather than 50, and they'll keep going until they start to see some signs of the slowdown in the labor market.
Mike McKee, I look at the jobs report, like layoffs at Lyft. I'm just happen to pick on Lyft here. When do they fold into this data? What's the lag before any given company's press splash actually is in the Mike McKee data?
Well, it's hard to know because you don't know how they're doing it. A lot of companies are letting people go, but they're doing it through attrition. And they're also looking at not hiring, they're cutting back on their hiring plans as opposed to actually laying people off. Now, if Elon Musk is going to fire 50% of his workers, that'll show up probably in a week or two in the jobless claims numbers, and in the total number of tech workers, it'll show up in another month.
Mike McKee, breaking down the numbers for us in about 5 minutes' time alongside Randy Krosner. We'll catch up with Jeff Rosenberg as well. And Tom, that's the question we started the program with this morning. We can all see it looking around, layoffs here, hiring freezes there. We can all see it looking around, inflation rolling over in certain places of this economy. We haven't seen it in the official statistics just yet. Well, and that's going to keep the Fed going.
Totally agree on the differences here and the importance of this number in 4 minutes. And I go to Dominic Costum as an outlier, saying even now they're super restrictive as inflation comes down. That's an outlier call.
Equity futures right now up 0.6%, a yield higher by a single basis point, 416.26 on a 10-year, on a 2-year, through 475 this morning. The jobs number up next, the estimate 193,000. You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
No one covers the world like Bloomberg.
The writings on the wall for the Bank of England. Just Stop Oil has spray painted the front door.
Recession in Europe, UK, and possibly the US.
Brazilians are out in full force celebrating the election victory of former President Lula da Silva.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
Welcome to Bloomberg Crypto.
Payroll seconds away in the United States of America. Futures going into that number up 0.5%. Yields going nowhere on a 10-year, 414.79 with the jobs number. Here's Mike McKee.
We talked about an upside surprise, and an upside surprise is what we got. 261,000 jobs created. That is much higher than the 193 that was anticipated. And we get 233 in terms of private sector payrolls, which may be a little bit more important. The Fed is going to be more concerned with what private companies are doing than government hiring. The revisions, 29,000 positive from the prior months. So you add that together, and you got 290,000 jobs we didn't know existed before the month of October. Unemployment rate ticks up to 3.7 from 3.5. It was 3.7 in August, fell back to 3.5 in September. So 3.7, progress in the right direction in terms of unemployment as far as the Fed is concerned. Average hourly earnings, 4.7% on an annual basis after a 0.4 rise. The 0.4 rise a little bit stronger for the month of October, but 4.7 is bang on expectations, and that's also a move in the right direction. And the labor force participation rate falls, 62.2%. There's your answer, probably, without me looking at it directly, for why the unemployment rate went up. So, John, how are people taking this?
Well, Mike, right now we seem to be trading on the upside surprise in the headline number and maybe not that unemployment story, but we can build that out. As you know, the first move, not always the right move when it comes to payroll, so we'll let this breathe, but I'll go through it as it stands. Equity futures now unchanged. They were positive on the S&P 500. We've talked a lot about the front end of the yield curve, the 2-year, up 7 basis points now, just short of 4.80. We came very close at 479.90. Yields up, stocks down, rolling over, and guess what's stronger? The US dollar. Euro dollar off the highs of the session, still positive by about 0.2%, but down from the day's highs of about 98.11, back down to 97.68. TK, it's an upside surprise on payrolls, and that seems to be driving things so far, and dare I say it, at least for now, and it might change in about 60 seconds time, Tom, but at least for now, good news is, what is it, Tom?
Well,
you're
busting my chops here, but you know, I'm looking at a market adjusting. The vigilantes are adjusting to a fully employed America, and I know what I just said there gets a lot of people upset. But
Tom,
that's the numbers I'm seeing.
Look, at the moment, we're trading on that headline figure. But Mike McKee, that 3.7% unemployment rate, if I'd just given you that and nothing else this morning, I wonder if we'd been having a different conversation at this time.
Yeah, I mean, people want to see the labor market slow down because they think that means the Fed is going to be able to do less or may not have to do more, depending on how you want to look at it. The underemployment rate ticks up as well. That's U6, 6.8 from 6.7%. And you look at the breakdown on an ethnic basis, which is what was the Fed's big thing before the pandemic, Black or African American unemployment, 5.9%, that's up from 5.8. Asian, 2.9, up from 2.5, and Hispanic, 4.2, up from 3.8. Throw in white, 3.2, up from 3.1. So every ethnic category saw an increase in unemployment during the month of October, which is kind of what the Fed sort of expected.
Well, but the other thing that is perhaps giving people pause is the month-over-month increase in wages, which actually came in hotter than expected at 0.4% versus the 0.3%. How much does this really underpin that the people who are getting jobs at higher wages than even people understand that they're getting? In other words, yes, there is a higher group of people who are just remaining completely out of the workforce, but those who are in are getting compensated more.
Well, they're getting compensated more, but it's not keeping up with inflation, so it's not helping. The question that the Fed is trying to answer or is afraid of hearing the answer to is whether or not people demand to keep up with inflation. So inflation's got to come down, or wages have to go up, or people are going to be rather dissatisfied. Now, as we fill in the holes in employment, that year-over-year number is starting to come down from 4.7. It was 5% in the month of September. It's coming down slowly. But the one thing I've noticed as I go through this report is that even with gains of 261,000, they're pretty widespread. The categories themselves, category by category, have slowed down some. Leisure and hospitality, remember we were getting hundreds of thousands a month. We get 35,000. And so you're starting to see some contraction there. Manufacturing, 32,000. That's still hanging in there. But construction, only 1,000 during the month. And that's kind of odd. I would expect that to go up just because of Hurricane Ian. Everybody's got to move to Florida and start rebuilding down there. There is no note that I see about Hurricane Ian in this employment report. It took place after the September one, but before the October one. So apparently it didn't have enough of an impact that it would be, here's a little bit of note, no discernible effect. That's what I was anticipating.
So there's the data, folks, as we digest this. I know 289,000 3-month moving average is the number I look at. John and I are looking at 4.77%, up 5 basis points in the 2-year yield. Randall Krasner knows these are abrupt moves. He mentioned that earlier. He is at the Booth School, the former Fed governor as well. Randy, you are a student of economic history. Let's say we get a terminal rate of 5.x%. Let's say we go back to CD rates of a time 20, 30, 40 years ago. Is it the same this time? Are we reverting back to a financial structure that we know, or are we in new territory?
I don't think we're going to be going back to interest rates at double-digit levels, which is where we were with when inflation was this high 40 years ago. So I don't think the Fed is going to need to go that high. But I think, as you can see with the 2-year moving up, the markets are saying, hey, this is a pretty strong employment report. We're not seeing cracks in the labor market yet. And so the Fed is going to have to continue on its path, and its terminal rate will be a bit higher than we thought.
What do corporations do? How do they adapt as we see the nominal yield and the real yield come up?
So that's, one of the things that the Fed's toolbox is to try to make financial conditions tighter, make it less attractive for firms to hire and less attractive to invest as hurdle rates go up, because both real and nominal rates would be going up, and that's their main tool for trying to slow the economy down and try to take some of the excitement out of demand, and so supply and demand can come together without as much price pressure.
I said let it breathe, and we have done for a couple of minutes, and equities have raised the losses post-payroll. So the S&P 500 is back up higher by 0.8%. That move at the front end has faded back to basically where it was going into the print at 476, yields higher by 4 basis points or so. I don't think this is the game changer at all for anyone out there. And by the time we get to CPI November 10th next week, we won't even be talking about what's just happened here in the labour market, Tom. We're still waiting to see real cracks in that labour market to get a better understanding that the dual mandate of the Federal Reserve is in conflict. And right now for the Fed, it's not. I'm going to have this conversation with Rick Reeder over at BlackRock in just a moment, Anastasia Amoroso of iCapital, Mike Collins of PGIM, and we will catch up with Secretary Marty Walsh, Tom, of the Labour Department at this administration. Looking forward to that a little bit later in the next hour.
Very good. We'll continue. The futures up 30. The VIX comes in 24.98. Lisa, gets my attention of a more buoyant market.
Yeah, and also the Fed funds rate was now pricing in a peak of perhaps 5.25% in June of next year, although that's fading a little bit as we start to go on. Randy Krasner, I'm looking at some of the details here, and this is actually a very confusing report to me. The unemployment rate now getting people's attention, perhaps, but the wage picture very confusing to me as well. What can you glean from the composition of jobs that perhaps are getting added or cut, and how that might be affecting the wage dynamic more than, per se, an entire inflation picture that the Fed can take away?
Sure, there's always one of the issues that you have to be careful about is exactly what you're pointing out, the so-called composition effect. what areas are seeing job increases more than others? Are those in general high wage or low wage areas? I haven't had a chance to dig into the details of the report, but that's obviously something one needs to look at. The Fed will be heartened that that we're not seeing an acceleration in the wage growth, that it's still around 4.7% where it had been. But it is hoping that is not going to rise, and it's hoping that it may come down a bit as they try to bring inflation down.
Yeah, I look at this, Mike McKee. I want you to jump in here, if you would, right now. I'm watching Mike, folks. Look at the real report, which is 10, 20, 30 pages long. Give it another number there for us and Professor Krosner. What matters to you?
Well, unemployment is what's been the interesting number today because it went up, and it's largely because of what we in the past would have said is bad news, but this time it is kind of what the Fed wants to see. In the household survey, the number of people employed falls by 328,000, while the number of people unemployed rises by 306,000. So a real difference between that and the establishment survey, which is not unusual, but it does tell you why the unemployment rate went up. We also had 22,000 people leave the labor force after 57,000 left the labor force the month prior. And so it's kind of interesting. It may be because kids have gone back to school and mothers have decided to stay home or something like that. But we're not seeing people drawn back in by the fact that there's so many jobs available.
Well, and Randy, that's where I wanted to really finish up here and just get your impression of why the participation rate is going down, why it is moving in the opposite direction, despite the wage gains and despite the job openings that we see in the JOLTS survey.
Yeah, this is one of the great frustrations that the Fed has, and Jay Powell's been talking about this for a long time, of trying to get, why aren't we seeing more people come back into the labor market? And I think it's a variety of factors. There are many of the older workers and more experienced workers are saying, hey, I know a lot of people who didn't make it through Corona. I want to make sure to have time with my kids, my grandkids. So you've seen a much lower labor force participation by older workers, and a lot of younger workers are saying, unless I can get a job where I can sit at home and kind of pick the hours that I want, I'm not going to bother to come in. And so it's hard, and despite all of these openings, it's not enough so far to be able to draw people in. Part of that is because even though wages have been growing nominally faster than they have in the past, the real wages, the inflation-adjusted wages, haven't been growing that strongly.
Randy Krosner, thank you so much for joining us. It's just a joy to have you with us on Jobs Day. He is at Booth School, London, and now back at Chicago as well. A headline that is out that gets us in front of our coverage that you will see Tuesday and Wednesday. Thrilled to bring you Bloomberg surveillance from the nation's capital for the election. Lisa, after the election, and this is from Mike Allen and the team at Axios, President Trump and his team eyed November 14 to start a 2024 presidential run.
Not exactly shocking, considering that it's very, very,
particularly
very
the last 24 hours.
likely that he's going to be running again. But it highlights how right after this midterm election, Tom, we are right into the presidential campaigning.
You're one of the days from November 8, 9, 10, 11, 12. Well, how's it going to change before we get to a supposed announcement from the former president? That again from Axios. Right now we go to Jeff Rosenberg, who was just wonderful on Fed Day, giving us the dynamics of a dynamic press conference as well. Maybe, Jeff, with BlackRock, maybe not as exciting as that press conference, but nevertheless, a job report of a fully employed America. From where you and your team sit, is this jobs report old news, present news, or indicate a buoyant future?
Yeah, great question, Tom. I think it validates what we think we know about this labor market, and that is that it is very, very slowly starting to show some effects of an economic slowdown, of the Fed's tightening. But go back to our conversation on the post-Fed day, it's all about the long and variable lags here. And so we're seeing, just the glimmers of what the Fed hopes to see in terms of the impact of their tightening this year, but it's going to take some time. And going back to what Lisa ended with Randy on, the most salient point I think here, and Powell mentioned it in the press conference, is the lack of labor force participation responding to this historic levels of openings. That's a huge disappointment. That's a problem because the economy is not responding to the Fed's tightening. And so they've got a lot more work to do. They're going to slow that pace, fine, but we really are not seeing the economic slowdown that's necessary for the Fed to get to that inflation slowdown. So this is a real challenge for the Fed and for the markets.
Jeff, since you walked up to your TV set at BlackRock, and we said good morning on Bloomberg Radio as well, the 2-year yield gave us a rounded up 4.76%. How does a grizzled pro like you adapt to yield, nominal, yield, real, moving so fast and furious?
Yeah, you take what the market gives you, and in this market, it's been a dramatic increase and restoration of yield for safe assets. You think back to the zero interest rate policy environment, the negative interest rate policy environment, that gave us TINA. There is no alternative. Now there is an alternative. And so it's adjusting to where the opportunities are. The opportunities are in the very front end of the yield curve, where we're pricing in, as Lisa talked about a minute ago, 5.25% peak Fed funds rate. Whether or not that turns out to be the peak depends on inflation. But the Fed signaled earlier this week to expect an increase in that terminal rate. The market's already there. So there's not a huge surprise when we get to the S&P. There may be more of a surprise on the inflation next week, but there's a lot of opportunity there because we've done a tremendous amount of work pricing in the normalization, the tightening, the movement to restrictive policy that the Fed wants to be at and are getting much closer to being at.
Do you think that the balance of likely outcomes, Jeff, is more likely that we're going to see a higher than 5.25% Fed funds rate versus one that is below that in terms of where we end up at the peak?
Lisa, it's very tough to make that call because it's dependent on the inflation call. And what do we know so far about the inflation call? Everybody's gotten it wrong. Every time we get a surprise to the upside to the CPI, what happens to the inflation peak expectation and therefore the peak of the Fed funds expectation? We continually move it out. So very hard to see whether or not that's the peak. If the inflation forecasts finally show up, if we get that 0.3 in core CPI next week, then I think 5.25 will be the peak. But there is a possibility here, and you're seeing it a little bit in the data. The lack of the data today in the payroll report, the lack of an expanding labor force, very strong wages. Is the risk of this alternative view that we are already in a wage price spiral? And if that's the case, then the Fed may have to do actually much more than that 5.25 that's currently priced in the market.
What does that do to risk assets, Jeff?
Well, I think it's a challenging environment for risk assets. We saw this in the post-press conference equity market reaction, that the Fed doesn't want to see financial conditions easing prematurely. They need financial conditions. Remember, the transmission mechanism is tighten financial conditions, then it affects the real economy, slows the real economy, and then the slowdown in the real economy slows down inflation. If the equity market gets ahead of that and eases financial conditions before the economy has a time to slow down and slow down inflation, then the Fed has to do even more. And that's why he pushed so aggressively back against that, the market is up. What do you think about that? And then he gave you the greatest hawkish hits to push back down the market. So in that environment, it's going to be challenging for risk assets.
Jeff, Ian Lincoln just publishes at BMO Capital Markets, always wonderful on fixed income, and he makes clear that this report gives Chairman Powell room to wait. He can now comfortably wait for these inflation reports that we see before the December meeting. Do you agree that it's not that it gives him degrees of freedom, but that this report gives him the room to really wait and analyze price change?
Yeah, I would agree that this report is not changing anything that we already have in the expectations for the Fed to begin a step down in the pace of the increases, but not necessarily ending that pace of increase until they start to see the development in inflation of a slowdown. So they can slow the pace because they want to incorporate the Brainerd perspective, long and variable lags, that important change to the statement that we got earlier this week. That's about the Fed acknowledging we don't want to go at 75 forever. We don't want to overdo it. We want to give time for the data to show up. And I think today's report is in line with that market expectation, doesn't really change it dramatically.
Are we going to go back to an era that was familiar over the past decade or so, where we finally grind through whatever this post-pandemic reality is, and inflation gets back down to around 2% or even below that, and then we struggle with the same types of disinflationary forces? Or is this a materially different decade coming up?
Well, this is the premise of your question is, do we go back to the pre-COVID secular stagnation environment? And if you look at market consensus expectations for interest rates, for inflation rates, there is that expectation built into market consensus. We would be highly skeptical of that outcome. There are significant structural changes.
We got a little frozen there on Jeffrey Rosenberg. I guess we'll exit there. We're going to exit 30 seconds later, and we'll do it now. Thank you for that. And a frozanical moment with Jeffrey Rosenberg.
Frozanical?
It's a frozanical moment of it just, it happens there. You have that. And thank God to my left, I've got Michael McKee to save us.
Well, yeah.
Before we go to Ira Jersey. Are you going to freeze on us here?
I'm here in person, so I don't think so.
Well, so Mike, you've been having a couple minutes to really parse through some of the details. Anything stand out to you?
A couple of interesting things just to go along with the news lately. Joe Biden's been wanting the oil companies to produce more. Oil companies say they can't find workers. There's only 400 people hired in oil and gas extraction in the last month.
400.
Wow.
400.
A statistic in the report.
You're
That's
not
great.
going to get a lot done.
That's the granularity
in
of
that
the McKee
situation.
world.
And we're also getting into the holiday season. I was just in a store and I wanted to buy a Thanksgiving card. I couldn't because they're all Christmas cards. At this point, the retail trade only added 7,000 total, and department stores and general merchandise stores lost jobs during the month. And the interesting thing is warehousing lost jobs during the month. Couriers up only a little bit. Well, what I'm wondering is if this is a seasonal a problem, a seasonal adjustment problem, in that when we had the pandemic, we all bought online. And that pushed up the numbers of people doing retail and especially the warehousing kind of numbers. Yeah. And now the seasonal adjustment factors are kind of off. Yeah. We've gone back, as Jeff Rosenberg said, to the pre-pandemic kind of hiring. And, this may not be an accurate representation of where we are.
Michael McKee, thank you so much for bailing us out of a frozanical moment. 10-year yield, 4.18%. We had a 4.76 on 2-year, comes in a little bit, 4.74. Futures up 34. And the VIX under 25 shows the oddities of the equity market. Ben Emmons just publishes and makes very clear we will see 5% yields. Ira Jersey joins from Bloomberg Intelligence, looking at the short-term paper, but also out where Ben Emmons is looking as well. Ira Jersey, how does our listeners' and viewers' world change with a 5% 10-year and maybe with certitude a 5% 2-year?
Well, I think we get the 5% 2-year before we get the 5% 10-year for sure. And I think we're going to continue to see some yield curve flattening, because I do think that as we get higher and higher in terms of short-term rates and expectations that the Fed's going to hike now above 5%. We kind of thought 5% was going to be the ceiling, but this data just keeps on coming in way hotter than almost every forecaster is considering. As the Fed pushes against the rising inflation, we're going to have the long end just lag moves in the front end of the curve. And you're seeing that a little bit this morning, but not quite as much as I think that we'll get if we do see a pretty hot CPI report.
So how deep could this inversion be? We've been talking all day about the inversion in the 210 spread that goes back to 1982, and this question of what kind of depth of recession that portends. How deep could that inversion go?
Yeah. So our forecast had been for negative 65 basis points on the 2s10s curve. We were, kind of approaching those levels. But I think if the Fed's going to go higher and above 5%, then that inversion just starts to get larger and larger. So let's imagine a situation where the Fed actually goes above the 5.25. That's the market's currently pricing, and goes to 5.5. I think you're going to end up with at least a negative 75 and maybe even a negative 100 inversion in the 2s10s curve, which it's not unprecedented. We saw even a deeper inversion back in the 1980s. But the point is that the higher short-term rates go, probably the deeper that inversion gets. It doesn't mean that we won't see, Ben Emmons' 5% 10-year yield, but I think you get there if, say, the Federal Reserve hikes to 6%, for example. So that's kind of the ratio. Call it a 50% beta between 2s and 10s, I think.
Ira, so many watching and listening have never experienced negative 75 basis points on the vanilla spread. What does that do to the banking system? Is that glory days for Brian Moynihan and Jamie Dimon in the banking industry?
Well, I think in the past, when banks did a lot more maturity transformation type of trades and borrowed short term and then lent long term, it mattered a lot more. It matters a little bit less now because some of the Basel regulations have significantly shifted the way that banks do their business, and they actually issue a lot more debt in term space. So it's a little bit less important than it used to be. Now, it still matters because there still are things like deposits. But the other thing that banks are, if you look at bank deposits as their total funding, it's a lot more, and banks just aren't increasing the amount that they pay, the interest that they pay on deposits as fast as the Federal Reserve is increasing the interest rate. So banks are just still taking advantage of that maturity transformation, and NIMs haven't come down that much.
Ira, 10 seconds. Tottenham or Liverpool this Sunday? What do you think?
Oh, Liverpool has not looked good the last couple of weeks. I'm going to give the edge to Tottenham.
There we go. You can come back. Ira Jersey, thank you so much. Bloomberg Intelligence. We need to switch to the equity market because the bond market, front and center, is out front in terms of rates of change, but the equity market's there.
Sort of, and that's a question of whether the equity market is getting what the bond market is getting and whether the messages somehow are missing each other in transit. Gina Martin-Adams joining us, Chief Equity Strategist for Bloomberg Intelligence. Is this labor market report good for stocks the way that it seems to be, at least in the knee-jerk reaction?
I think it's a net neutral for stocks, Lisa. I mean, I think it confirms what we already know. That is that labor markets are still relatively tight, wages are still relatively fast. Maybe the equity market is taking some solace in the idea that the unemployment rate started to tick up, and that might lead to more weakness going forward. But I think it's a net neutral report, frankly. Think about where we were earlier this week on the equity market. There's been a lot of volatility in the interim, so I wouldn't attribute all of today's move to this report specifically.
Hey, Gina, we don't have much time, so I want to ask you, with immense respect for the hundreds of people that you work with in the equity space, where in the income statement coming out of Q3 into this absolutely historic time, where in the income statement is your team studying the most? Top line, down to the bottom line. What's the mystery?
The most important point to watch in terms of the broader equity market fundamentals is the operating margin line. Operating margins always trough before the earnings trough. Operating margins will always give you a clue as to when you're at your worst point in time. This is incredibly important and actually related to the labor market data that we're getting today, because many S&P 500 companies are producing negative operating margin growth on a year-ago basis. They're seeing operating margins fall. But also several S&P 500 companies over the course of this earnings season have announced layoffs or job freezes. So the index is always going to be in front of what you get on in the economic news, and we are starting to see companies react to operating margin weakness through job cuts, or at least freezes to their labor force. So you will see operating margins finally trough before we start to get some recovery in earnings. We think that trough may come as early as the first quarter. That certainly is what's in analyst expectations, but there's a lot of volatility in the interim.
Gina, we've got to leave it there. Gina Martin-Adams, thank you so much, and we'll look at that operating income analysis across Bloomberg Intelligence here in the coming days and weeks. Lisa, I've never seen 3 days like this. There's been some joy along the way, August of 1998, some early things in the 90s, et cetera. These 3 days cumulative to the press conference, the ballet in London, and what we just witnessed today, it's the most unusual time.
I think framing it out, the idea of a 40 basis point two-year yield 12 months ago to now like going to 4.75%, 4.73% highlights the regime shift and the unique moment that we're in, that suddenly everything has to reset at a new level. And the question is, what does that look like? And when do we understand the contours of that new reality?
I mean, we will see. And then, of course, to Washington next week.
Well, yeah, and to Washington in about a half an hour coming up at 9:30 a.m. Eastern. We do hear from Marty Walsh, U.S. Labor Secretary on Bloomberg TV and Bloomberg Radio. How do they really talk about a labor market still very strong when everyone talks about inflation being the foremost problem, and you need to have a different scenario in the employment market? From New York, this is Bloomberg.
It is Payrolls Friday. Let's get you some reaction. Live from New York City this morning for our audience worldwide. Good morning, good morning. Equities positive by a little more than 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue. It's Jobs Day in America.
Jobs out of
the employment report. Hey, this was a pretty strong employment report.
The labor market is still very tight. It validates what we think we know about this labor market.
So the Fed is going to have to continue on its path.
We have ways to go before we actually can pause.
The next box you need to check is labor.
Until the labor market weakens significantly, I think they're going to continue hiking.
We are watching for signals of a shift.
You check that box off, and I think that's when the Fed reverses course.
We are looking at job, the layoff announcements, they're picking up.
You see sort of weakening demand in the ISM surveys.
But right now, there's nothing to suggest.
We're not seeing cracks in the labor market yet.
Let's get a breakdown of that data. We can do it with Mike McKee. Mike McKee, make sense of this one for us.
Gee, John, I'm not sure I can do that. Peter Cheer had the best remark this morning so far. It's hard to make good or bad out of this report because there's a little bit of everything in it. 261,000 jobs created. That's the bad, at least from the point of view of the Fed, which would like to see things slow down some. And look at the revision to September up to 315,000. Then you go down a line and the unemployment rate rises to 3.7%, but not because more people came into the labor force, which the Fed was looking for, but because more people lost jobs. And a lot of people who were employed are not working this month. The labor force shrank during the month. The participation rate falls. Now, the only good news here at the bottom is that average hourly earnings fell. Now, that's not good news if it's your earnings that didn't go up as much, but it's good news for the Fed because it suggests maybe some progress against the inflationary impact of higher wages. Where are the jobs? Well, manufacturing stays strong, 32,000. Service jobs, 200,000. Manufacturing was up. Service jobs were lower. That might be a sign of something good ahead. Food and drinking places. We were reporting increases in the hundreds of thousands not so long ago. Only 6,000 jobs added there. And of course, that last one, you're not going to be surprised to know. 8,700 jobs lost in real estate. Mortgage brokers in the last 6 months down 35,000 jobs. The average hourly earnings is an interesting number because it's not the total amount of compensation that people get. The Fed likes to look at the ECI, which came out last week, but these numbers are, at least you look at the graph, moving slightly in the right direction. You'd like to see a little bit better than that. And that leaves us, John, with the question of where do we go from here in terms of the Fed. At least the markets are thinking that we are going to see a higher terminal rate. It's gone up just a little bit in the last couple of days since Jay Powell was last with us. And they're thinking that the Fed is going to be somewhere above 5% at this point, somewhere between 5 and 5.25%, certainly higher than the Fed's dot plot and higher than even some in the markets had been predicting before we went into this week.
And for many in the last 30 minutes, this jobs report just not a game changer. Mike McKee, thank you, sir. And next week, all we'll be talking about is CPI. CPI. next Thursday, November 10th. Futures right now positive. Dropped off after the jobs report, then bounced back. Futures up by 1.3%. Similar move in the bond market. Yields much higher, then faded. Your 2-year got very close to 480, now back down to about 471-ish. Similar story in the FX market. Bit of dollar strength for a moment, a heartbeat, then ripped again. Euro strength, dollar weakness. Euro dollar 98.59 as session highs there and thereabouts. That currency pair up by a little more than 1%. Rick Reeder of BlackRock joins us now. Rick, I've given you about 34 minutes to try and make sense of this one. What's your big takeaway from this morning?
John, I need more than 34 minutes. Listen, I think this jobs report is similar to what we're witnessing in the economy. You've got a mix of dynamics at play. I mean, when you look at that service sector number, you look at particularly leisure, you look at education, the numbers are strong. I mean, the service part of the economy is still in really good shape. We talk about, Michael said, we're coming off a little bit. I mean, listen, the numbers are slowing from, you look at the 3-month moving average of jobs versus 6 months versus 12 months. We're moving in the right direction. We are slowing. But the service sector, which is 80% of the hiring, is still in very solid shape. I was looking at today some of the airline numbers, the amount of hires they're making. Leisure, hospitality, restaurants generally, although some back off today, it's pretty solid. I mean, and this is why you've got a Fed that's willing to over-tighten to deal with some of this.
Is that your takeaway, Rick? There is a commitment here to over-tighten from this Federal Reserve.
Jonathan, I have to say, when you look at that press conference, that was the thing that blew me away. When you actually, listen, the Fed was too easy, too long. I think you said it. We've said it on shows prior. You think about where we were in March, 0% funds rate and doing QE. And now we've got the most historic set of rate rises while draining liquidity. Gosh, I think over-tightening, while the chair talked about the ability to then come back and use his tools, I don't think that makes any sense. I think you've got to be, I mean, we've moved a historic amount. You see it in the housing market. I mean, boy, these are historic drops in terms of the rate of activity in the housing market. You'll see that in price flow through. You're going to start to see it in auto finance. Clearly, you're seeing it today. Gosh, I think the Fed's got to be careful about, quote, over-tightening. Because when you think about what's happening, you have an economy that's operating in a pretty good place. You're closing the income gap. Wages are going to start to come down. That being said, they are offsetting an inflation shock. That is really important, particularly for lower and middle income consumers. So, listen, I think the Fed's got to be really careful about that comment about over-tightening. I don't think we've got to keep veering the boat from one side to the other side. They've moved a lot. I think, quite frankly, I think the moves they've made have been brilliant this year. Going further to over-tighten, I don't know. That one was I thought a bit excessive.
Well, I'm with you, but we've got to question that underlying assumption. And that underlying assumption in very simple terms is that they still believe, this chairman believes, that the risk of doing too little outweighs the risk of doing too much. Now, Rick, if you think they're wrong, and if you think the risks aren't that asymmetric, what are the consequences for this market going into next year?
So, listen, I think you've got to manage your risk with the dynamics. So there's the Fed did, the New York Fed did a great piece on R-star and double R-star. You think about how the financial economy reacts to and what the equilibrium rate is in the financial economy relative to what it is in the real economy, particularly a service sector that's not as interest rate sensitive, which is what 2/3 of consumption is as an economy. But the financial sector becomes increasingly sensitive to these moves in interest rates. So what do you do with it? You got to be really careful. When you think about going into next year, where do you take the risk? How do you take the risk? Where's your convexity to the upside? We've talked about running a lot of cash in portfolios. We're starting to use our cash because you're getting, and we've talked about this, you're getting front-end yields that you can buy 1-year corporate paper at 5%. You can buy AAA securitized at 6.5%, 7%. These are incredibly attractive levels. You got to just be careful about how much, where your convexity to the upside is and the risk you're taking. Do you want to do a lot of EM when they could over-tighten? Do you want to do a lot of down the capital stack when they're potentially going to over-tighten? Big considerations going into next year.
Well, Rick, this was your line going into next year. Wall Street Journal over the weekend, you spoke to them. Great piece, by the way. It was you and others.
Thanks,
Here's
man.
the quote. I'm more excited going into 2023 than I've been in a really long time because we're going to have so many different opportunities. What is different about this moment in your career, Rick, relative to the last few decades?
So thanks, Jonathan. So the yields, I mean, AAA assets, you think about in my career, the ability to buy AAA assets at 6 to 7%, the ability to not take a lot of interest rate risk, not take a lot of credit risk, and capture these yields in an environment where volatility is going to be high, you're going to create opportunities across the markets. Listen, if the Fed is willing to go that far, then you're going to get some defaults accelerating. You're going to get some opportunities in distressed markets. You're going to get some cap structures that are going to be interesting to do some refinancing around. That is an exciting period. In the interim, we can clip yield in so many different ways without taking a lot of risk in the portfolio. It's a pretty good environment, John. You think about how many months were we on the show talking about negative interest rates?
Yeah.
Negative interest rates, which now you're getting incredible yields in high quality assets. So I don't know. I'm pretty excited about next year and the dynamism that this is going to present.
Rick, can we live with it though? Can we live with Fed funds somewhere between 4 and 5 over a sustained period? Do you think we can, or is this just a moment in time?
Jonathan, I think the answer is it's I hate to be wishy, it's unclear, and this is part of why I think the Fed needs to be really careful about how far do you go, because we haven't seen this fast a tightening. We've never seen a pandemic reopening. Listen, the goods part of the economy is in recession today, no question about it. Service sector is moving back to a trend because you had this extraordinary slowdown during pandemic. So it's pretty unclear, and this is part of why I think, gosh, after you move this much, you have to sort of think about, gosh, the real estate market. I know I'm doing this in a piece today. There are about 2.5 million people attached to the real estate market in this country by the quoted metrics. But there's a multiplier of about 9 and change times of that. It's about 21 million jobs attached to real estate. You think about brokers, you think about tax attorneys, you think about all the maintenance, et cetera. It's incredible. When we lift rates, you get the mortgage rate over 7, it will break some things. So we're going to see a lot. Can the economy withstand a restrictive rate for a long period of time? It's unclear. There's no question in my mind you'll see some things break along the way. It's part of why the opportunity set's going to be so robust next year.
Rick, I've got to ask you this. Do you think this is the calm before the storm? And the reason I ask that question is because Bob Michael at JP Morgan thinks it is. His view right now, despite what's happened with fixed income, he just wants to sit there and hug high-quality assets, the assets that people are going to want when it hits the fan next year. Do you share a similar view at all?
So, listen, I think there's a backdrop. So you take last year, nominal GDP was about 11. Year-on-year, nominal GDP, again, most of it coming from inflation, is year-on-year still running at close to 9. Again, much of it inflation. Boy, you solve a lot of problems when you have nominal GDP, particularly in a highly indebted economy. So, and you've got a service economy, it's most economy, it's operating at a really strong level. If China reopens, you get global growth that starts to improve. So, listen, I think the base case is that the system works its way through. It's part of why I don't think the Fed needs to be so aggressive in this comment of we'll over-tighten. But listen, I think we've not seen this type of rapid tightening before. You've never seen that, quite frankly, you think about the geopolitics, Cold War dynamics, et cetera, we're talking about. It's pretty unclear. But I think the base case is the system will be in generally good shape. Part of why I think you can invest, but you got to be thoughtful about where and how you do it. By the way, you can buy long bonds, quality long bonds today in some of these big investor-grade companies in the 50s. I can buy quality investor-grade companies in the 50s because of where they issued before. There's some things to do to invest, and I think it's worth doing some things to invest. I just think you got to be thoughtful about where you're taking convex risk and protect the downside in case we get more volatility than expected.
Well, it's great if you were holding cash coming into this mess, and I know you were holding a lot of cash coming into this mess. Rick Reeder, thank you, sir, over at BlackRock. Appreciate it, Rick, as always. Yields, 2s at 470, very close to 480 a little bit earlier. Equity futures higher this morning by 1.4%. China reopening, part of the conversation, the rumor mill, it's out there. Still no confirmation from the Chinese, but look at this move in crude. Brent crude up 4% to 98.50 on Brent. WTI 92.30. Coming up on this program, corporate America pumping the brakes on hiring.
The problem is demand is slow. We're expecting all of this policy tightening to hit. We'd expect about 2 million job losses net over the course of 2023.
That conversation coming up with iCapital's Anastasia Amoroso and PGIM's Mike Collins. Plus, later, we'll get the view from the White House. U.S. Labor Secretary Marty Walsh with the view on the payrolls report coming up shortly.
Chris, go.
After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin. Not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
Businesses were catching up with demand over the past year. They were building inventories, they're raising production, they need employment for that. The problem is demand is slowing. And as we head into the coming year, we're expecting all of this policy tightening to hit. We'd expect about 2 million job losses net over the course of 2023.
The labour market proving resilient in another strong payrolls report. Corporate America telling a different story. The list of companies tightening their belts growing by the day. Amazon, Apple hitting pause on hiring. Lyft, Warner Brothers delivering the latest round of cuts. And Credit Suisse doubling down with the fresh round of job cuts themselves. Kaylee Lyde struggling to keep up in just the last 24 hours.
Yeah, I mean, at least for Credit Suisse, John, that's just as much about its never-ending series of struggles as it is the macro picture. And you could say the same thing about Twitter, because Elon Musk overpaid $44 billion for the company and now wants to cut costs, which is why come 9 a.m. Pacific time, so less than 3 hours from now, 3,700 Twitter employees could lose their jobs, roughly half the workforce, although there will be some legal battling within that, considering there's already a suit in which workers say the company isn't giving a notice of the layoffs and therefore is in violation of federal and California law. So we'll have to see how that one plays out. But of course, it's not just Twitter within tech that is seeing job announcements. Just in the last 24 hours, as you said, Apple saying is pausing hiring for roles outside of R&D. It is worth noting that R&D is where they still spend a lot of money. That spending actually up 20% in 2022, which is the most rapid expansion in spending going back to 2018. But then you also have Amazon saying it will pause adding new corporate workers. Lyft going even further by announcing it will eliminate 13% of its workforce. And of course, as broken this show yesterday, Stripe is laying off 14% of its employees. So it's a literal laundry list, and it extends beyond the tech sector as well. Highlighted in a report from Challenger Gray and Christmas release yesterday, it showed job cuts announcements were up 48% year on year in October, actually the 5th straight monthly rise in a row. And they say more cuts are on the way as companies anticipate a downturn. The question is, John, when does all this corporate behavior start to show up in the economic data in a more material way?
We've been asking the same question all week, Kaylee. The same question all week. Kelly Lyons, thank you. Joining us now, iCapital's Anastasia Amoroso, PGIM's Mike Collins. Anastasia, first to you. Let's get your reaction to this jobs report, then we'll build off from that. Your thoughts?
Well, it was very interesting, and there's clear divergence going on between what's going on in the household survey and what's clear is that the economy is weakening, and you're starting to see some parts of weakness in the labor market as well. I mean, the key difference between the two surveys is that you have the self-employed workers, the household workers that get captured in the household survey, and that clearly shows that you have had over 300,000 of job losses in that. So I think that is a sign of what's to come. To your question that you were just talking about, I think we're going to see these layoffs that we were just witnessing show up in these numbers over the next few months. And look, you can't not cut jobs in this environment because you had profit margins that are starting to shrink for corporate America. And that was very much showcased by big tech, but other companies as well. So demand is slowing. You've hired a lot. So you're going to have to cut some jobs. Then housing is just completely has fallen apart. And as Rick was just mentioning, there's so many jobs that are tied to the housing market. I think it's inevitable that we see some of those job cuts, unfortunately. So I think the glimpse of what we saw in the household survey is going to show up in the other survey as well.
Mike Collins, your reaction, sir?
Yeah, John, I think this continued really strong labor market data is a little bit of old news, as Anastasia said, looking out 6, 12, 18, 24 months, which is what, good long-term investors do. I think it's going to be a very different picture, right? We are going to have a landing. The big question that you and we are all asking ourselves is it a soft landing / maybe mild recession or something much worse? But either way, I think earnings are coming down due to profit margins, demand coming down. Yeah, the service sector is robust. Business travel is back. Restaurants are full. Planes are packed, right? So that's a good tailwind. This reopening trade, not only in China, but in the U.S., I think has some legs to it. So there's definitely some credence to the idea of a moderation in growth from here. Maybe we get 0 to 2% GDP for the next year or two. I think that's a really good outcome. I think that brings inflation down into the 3s. It probably leaves the funds rate near 4, not 5, right? So I think to Rick Reeder's point, I think 5.25 is going to be a big overshoot in retrospect, and the funds rate will ultimately land somewhere lower than that.
Mike, I keep hearing short and shallow. What are the assumptions that underpin that assessment? Where does that come from?
Yeah, a short and shallow recession, John, just assumes that, corporate earnings come down a little bit, but they don't go to negative 10% year over year next year. They go to 0, right? And default rates don't go to 7 or 10%. They go to 3, 4, or 5. That's and the unemployment rate goes from 3.5 to 4.5, not to 6.5 or 7. Those are the two scenarios we're dealing with. I mean, unfortunately, the probability of each of those two scenarios, the soft landing and the harder landing, are, I don't know, maybe it's 50-50, right? I mean, I actually think the soft landing is a very probable scenario, but in either scenario, you end up with a lower interest rate structure than you're dealing with right now.
That's the world we want. Anastasia, any indication that that's the world we'll get?
Well, I think a soft landing at this point probably does mean a mild recession. And I do think that actually might be possible, because one of the differences between a true hard landing in a financial crisis and a soft landing, a mild recession, is that excesses need to be corrected. And if you had leverage that accumulated in the system, and that leverage needs to be reduced, and that leads to fire sales of assets, and that leads to widespread dislocation, I think that's what really causes a really tough recession and a truly hard landing. And I think the good news today is that we don't necessarily have that today in the economy as a whole. We have pockets of leverage that we'll point out we need to monitor. But if you look at broadly at the U.S. consumer, for example, this is not the global financial crisis. You had the debt service for the U.S. consumer that is half of what it was during GFC. So you have a lot more resiliency on the household balance sheets. You have a lot more resilience, I would say, generally on the corporate balance sheets, as well as leverage is in check and cash balances are really quite high. And then the banks are well capitalized as well. So I don't think this is a scenario where you have a slowdown in economic activity, a recession, maybe negative earnings, and that leads to this vicious cycle. However, there are pockets of leverage that have been accumulated. And I would point to the leveraged loan market. That tripled in size in the last number of years since the financial crisis. It's the same size as high yield market right now. And high yield credit quality actually improved, but leveraged loan credit quality on the index basis has deteriorated. So I worry about some of those companies that coming into the year expected the rates to rise by 75 basis points. And instead, they're now having to shoulder the burden, the cost of 4%, over 4% rates. So that's the part of the market that I'm particularly worried about may actually have a hard landing.
Mike Collins is going to have thoughts on that. We'll come back to him on it in just a moment. Mike Collins, Anastasia Amoroso, lucky to have him with us. Going into the opening bell, equity futures up by 1.35%. The morning calls up next.
big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Minutes away from the opening bell, equities up 1.5%. Let's get you some morning calls. Let's begin with Piper Sandler upgrading Arista Networks to overweight, highlighting the company's impressive earnings and long-term growth strategy. Oppenheimer downgrading GoPro to market perform, expecting macro headwinds to continue weighing on consumer demand. And finally, UBS downgrading Teva to sell, forecasting significant downside to estimates with the company's CEO stepping down next year. Coming up on this program, the view from the White House, the Labour Secretary Marty Walsh on the payrolls report. That conversation up next. The opening bout just around the corner. Futures higher by 1.5%.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We are seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
No one covers the world like Bloomberg.
The writing's on the wall for the Bank of England. Just Stop Oil has spray painted the front door.
Recession in Europe, UK, and possibly the US.
Brazilians are out in full force celebrating the election victory of former President Lula da Silva.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
23 seconds away from the opening bow this Friday morning. Good morning to you. Equity futures positive, coming off the back of a four-day losing streak on the S&P. We're up by 1.6% on the S&P 500. Post payrolls, upside surprise, maybe shaken up by a higher unemployment rate as well. Nasdaq futures higher too, up 1.9%. The losses this week on the Nasdaq before today, though, down more than 7 percentage points. We're trying to take some of that back. That's the opening bow. Switch at the board and get to the bond market. We look a little something like this on a 10-year, 413.95. Yields down by almost a basis point on a 10-year maturity. Front end of the curve all over the place this morning. 475 at one point before payrolls. Post payrolls at one point very close to 480. Right now down about a basis point on the session. Let's call it 171, 471 rather, on a 2-year. Outside of that in foreign exchange, euro dollar. Look at this for some dollar weakness across G10. Euro dollar 98.71. Euro dollar up by 1.25%. And China. $92.12 on WTI. We're higher by 4.5% on the session. Not just off the back of this story in China driving the commodity market, the equity market too. Fresh reopening hopes lifting Chinese stocks on US markets once again. Reports saying China may be planning on substantial changes to its COVID policy and scrapping rules that penalize airlines for carrying virus cases into the country. Kaylee Lyons has more. Kaylee, this has been a story for us all week.
It has, and it has led to explosive moves in the Chinese markets in Asian sessions, including the Hang Seng China Enterprise Index, which had its best week since 2015, but it has carried right over into U.S. trading with those ADRs of big Chinese technology companies charging higher early on in this session. Alibaba up 10 percentage points, as is JD.com and Neo. Baidu up 11% as well. These are huge double-digit moves for companies that have seen a lot of volatility as of late. And of course, part of that volatility related to the regulatory environment as well, not just the regulation from Beijing, but also here in the U.S. with questions around the auditing of these companies that are listed on U.S. exchanges. We got good news on that as well overnight, though, in addition to all the optimism about reopening. Inspectors finishing their on-site work on location with these companies in terms of those audits ahead of schedule. So that is leading to some optimism that this may all get wrapped up pretty soon and that the threat of being delisted from U.S. exchanges no longer is going to be an overhang on these companies. But of course, an overhang it has been, in addition to COVID-0 and everything else, why the Golden Dragon China Index, HXC, is down about 77% from its peak in February of last year. But I would note that we've seen other high beta plays following that same pattern. The SPAC Index, for example, or the IPO ETF, even the ARK Innovation ETF, which is the poster child for growth, high multiple companies. All of them have seen downward decline, John. But of course, for Chinese companies, it has been very, very difficult. The picture, though, may be getting brighter, although we're still waiting for definitive confirmation that China is indeed going to start slowly reopening.
Kaylee Lyons, and if we get that confirmation, we all need to work out, is that good news?
Yeah.
Good news because we unravel some of those supply chain issues, or whether it's bad news. Bad news because we push a surge of demand through this commodity market. Kaylee, which one is it?
Well, I think it may be both, and it's good news on the growth side because this is the second largest economy in the world. Perhaps it can shore up growth as we face an economic slowdown in other areas. But at the same time, if you have an unleashing of Chinese demand in an already supply-constrained world while China has been offline, that's not good for the inflation picture. And that creates a very difficult, complicated outlook for central banks like the Federal Reserve, especially when the labor market isn't slowing down either.
Kaylee Lyons, thank you. Let's whip through the price action on Brent crude, 98.41 off the back of this story. I think that is the story right now, the prospect of China reopening, driving a bid into copper as well in London. LME copper is up by more than 6% on the session. I'm sure you're interested in where WTI crude is this morning. WTI 92.23, up by 4.6%. For the broader equity market, we look a little something like this on the S&P, up by about 1.3%. Healthcare is lagging. Still positive, though. Leading is energy, up by 2.3%. Surprise, surprise. And post-payrolls, your bond market, unmoved on a 2-year now, was pushing 480, now at about 4.71%. From New York, I'm pleased to say that joining us now is U.S. Labor Secretary Marty Walsh on TV and on radio. He joins us from Washington. Marty, fantastic to have you with us on the program, sir. First, on this show, to respond to this payrolls report. The big question for many of us right now, Secretary Walsh, is how much you think this labor market needs to cool to help get inflation lower.
Well, I think what we're seeing here is we obviously saw good gains this month, low unemployment, and that's really strong. I think what we're starting to see now is us transition to a slow and steady economy as we move forward here. I mean, we're seeing there's still jobs available out there. We're seeing the wages have gone up a little bit, a little less than last month, but we are seeing gains in those sectors that still are hiring people that need people to work in them.
The question many people are asking is whether higher unemployment is a price worth paying to get inflation down. Secretary Walsh, you and I have talked about that. That question has taken on renewed importance this week after some of your Democratic colleagues down in D.C. have sent a letter to Chairman Powell. Do you think higher unemployment is a price worth paying to get inflation lower?
Certainly, I don't want to see high unemployment because I think too many people in this country need to go to work. They're seeing opportunities where workers across the board average of higher wages right now for 4.7%. I think this month the wages are at in the hospitality industry are higher. I think there's an opportunity for us to bring inflation down and as well as having employment going on in the country. We're living in a very, and I've said this many, many times now, but in very different economic times, and I certainly don't want to see our unemployment rate go high. 3.7%. We've been averaging between 3.5 and 3.7% over the last, I think, pretty much the last year, and that's a good place to be.
Well, what's the mechanism for that to happen?
As far as, excuse me, what?
To get inflation down without unemployment going up.
Well, I think the Fed has raised rates. We're seeing a little bit of steadiness now, a little bit of cooling off. We're also seeing opportunities, as I mentioned. We're starting to see signs of a slow and steady economy. I think we're getting back to pre-pandemic where we were. We're not going to continue to see these gains of hundreds of thousands of jobs every month in our economy because eventually, we're going to run out of people to fill those jobs. We're seeing the supply chain. I didn't hear your whole segment right before this, but as China opens up, we're going to start to see more supplies coming across the ocean. We're seeing pressure on gas prices coming down a bit. We need to continue to stay focused on our gas prices, our natural gas. We need to continue to bring costs down at the kitchen table every possible way we can, and we just got to continue to do it month over month. There's not just one quick fix to it, as you know, and you guys talk about it all day long. There's lots of different things that have to happen here.
Well, the Federal Reserve's talking about causing pain. Chairman Powell talked about that in Jackson Hole, Wyoming. He said, well, higher interest rates and slower growth and softer labor market conditions will bring down inflation. They will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation, but a failure to restore price stability would mean far greater pain. Secretary Walsh, what would you say to those that may say to you that you're not being upfront about the pain that we need to go through to get inflation down?
Well, I could say this. People went through a lot of pain in this country in the last 2.5 years with the pandemic. People lost their job. People were concerned about what the future is. And we're living in a very interesting time coming out of a pandemic. And I think that people are feeling pain. They're feeling pain at the kitchen table. And we have to do everything we can. As an administration, the president has passed legislation, Inflation Reduction Act, that long-term will help us bring down inflationary pressures. We're working on supply chain issues to bring down inflationary pressures. The Fed are doing what they have to do to bring down pressures, and we have to continue to work as an all-government approach, if you will, and do everything we can to bring those pressures down at the kitchen table. I think by having unemployment rates around 7-8%, that's a lot of unnecessary pain that people in America don't need right now, and people that are working won't need that pain either.
Do you concede it has to go higher, though?
No, I'm not there yet. I'm one of the people that hold out saying that I would like to see the unemployment rate continue to stay where we are, even go lower if we can, and work other ways through this inflationary pressures that people are feeling.
I've got to put you on the spot there, Secretary Walsh. How does unemployment go lower and inflation comes down too? How do you think that happens over the next 12 months?
I think that people are trying to compare this economy to what we've had in previous economies. We've heard people talk about on shows all across America and people in boardrooms talking about recessions and comparing this moment in time to past times where we had recessions. It's very different. It's a very different period of time, and we've never seen inflation at such a high rate and unemployment at such a low rate in the history of our country. So we have to just continue to do everything we can, use all the tools, all the mechanisms we have to bring those costs down. Some of this was caused because of a pandemic, because of supply chain issues in the very beginning. Part of this is because of gas prices. This is a worldwide crisis that people are feeling with inflation and things that we're doing here in the United States. We are bringing, I think we're being a little more successful here in the United States than in other parts of the world.
You talked about the mechanism. Forgive me for calling that a lot of word salad, because it felt that way on my side of it, listening to it, Secretary Walsh. You talked about the mechanism for this to happen. Yes, unemployment is very low and inflation is very high, and that's why most people assume that unemployment will have to go up for inflation to come down. You still haven't really told me how you think that's going to happen. What are you doing to make that happen? I understand that's the world you want. That's not the world we have. How's that going to work?
I'm not an economist, number one, and I think that has to be very clear. And number two, when you think about where we are at this moment in time, what I'm going to do as my job as Secretary of Labor is doing everything I can is to make sure that Americans have opportunities to get into good-paying jobs, whether it's through workforce development, apprentice programs, working with states and cities all across America. That's my role and responsibility right now. My role and responsibility when it comes to inflation was making sure that supply chains are moving forward, making sure we didn't have 700 ships off the coast of California and Seattle and Portland and the West Coast where we did have it, making sure that those goods and services came into our country, making sure that we don't have disruption in our supply chain, whether it's through negotiations on ports or negotiations on rails. Those are things that I'm focused on right now, forward-looking, to make sure that we're doing everything we can, that we don't add to the inflationary pressures that people are feeling in America. Other folks are working, Secretary Yellen, Secretary Raimondo, and the Chairman Powell, all those folks are also working collectively on making sure bringing down inflationary pressures.
You've been part of the negotiations with the rail unions. You mentioned that just there. Why haven't they signed the agreement?
We have 6 of the 12 agreed upon. We have 4 contracts still out, and we have 2 contracts that were voted down by the members that we're currently, I'm encouraging both sides, the rail and the companies, to stay at the table and get another opportunity to get another vote on before we hit our deadline in November and December.
Are you actively involved in the negotiation again?
I'm not actively involved in, per se, the negotiation as far as what's in and out of the contract, but I am very active in making sure, in talking to, I talk to the representatives of the companies on a daily basis, and I talk to different unions almost on a daily basis as well, to make sure, particularly the 2 unions that didn't ratify the contract. 6 unions have ratified. There's another one going to come in the next couple days, and then we'll have 3 left out there. So hopefully by this time next week, we will have many of these contracts ratified, and we're down to the last 2.
Hope. What if we don't get that? What preparations have you done just in case this falls apart?
Well, there's a process that goes in place. And the worst case scenario, I'll play worst case scenario for a minute. If we don't get to an agreement, Congress will have to take action, and that is by design in the Railway Act. The president has the authority to put together an emergency board, which he did. They came back with recommendations. The unions have to ratify. There's 12 different unions, and if the unions don't ratify, we have 2 right now not ratified. Congress is the last stop that would have to take action.
Secretary Walsh, thank you, sir, for your time again today. We appreciate it. The Labour Secretary there, Marty Walsh. Equities right now up 0.9% on the S&P. Coming up, the conversation continues down in Washington. President Biden kicking off his final campaign push with midterms just 4 days away.
Today, we're in a much better place, although people are still hurting. We got more to do, but 10 million jobs created since I take office. That's more than any time.
That conversation up next.
This month, Bloomberg is live at COP27 in Sharm el-Sheikh, Egypt. Bloomberg Television and Radio will have complete coverage as world leaders, business insiders, and decision makers gather to take action toward achieving the world's collective climate goals.
What are your top 3 priorities?
There is an ability always to find the new and innovative ways to meet the challenge and at the same time take into consideration the pressures that exist.
Special coverage begins November 7th, only on Bloomberg, your global business authority.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, I'm a big believer in
we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
As Americans decide the future of Congress and state legislatures, Bloomberg will be live in Washington, D.C. to cover the results as they break and provide insight about what it means for the country.
We're in a divided country, and these are really close elections. We take a look at what the races could mean for Wall Street.
Special election night coverage starts at 8 p.m. on Bloomberg Television and Radio. And tune in to Surveillance live from D.C. at 6 a.m. on Wednesday for the latest overnight. This is Bloomberg.
My predecessor was the first president then Herbert Hoover, who actually lost more jobs than before. He had fewer jobs when he left than when he came in. Today, we're in a much better place, although people are still hurting. We got more to do, but 10 million jobs created since I take office. That's more than any time.
President Biden touting the economy with 4 days to go until the midterms. This, as his predecessor, Donald Trump, eyes a 2024 run for the White House.
In order to make our country successful and safe and glorious, I will very, very, very probably do it again. Get ready. That's all I'm telling you very soon. Get ready.
AMH down in D.C., very, very, very probably.
Yeah, and John, and there's some new reporting from Axios that says that his inner circle, the former president's inner circle, is eyeing a November 14th potentially launch date for that 2024 presidential bid. And also with a nod to this, yesterday we heard from Kellyanne Conway saying she thinks the president will announce this soon after the midterm elections. So it does look like the former president is looking to run again in 2024. Meanwhile, of course, we just have the midterm elections coming up on Tuesday. And John, the top issue clearly is the economy. And we see that today with the jobs report, this White House just putting out a statement, the president really leaning into the fact that this was an upward surprise. Yesterday, we heard from the press secretary saying they were expecting 150,000 jobs to be added. So this was definitely a win on that part. But the biggest issue is that even though there is a monthly wage gains, the wage gains are not meeting the fact that prices are rising. And that's really just the simple math that's getting voters out to vote.
AMH down in D.C. Anne-Marie, thank you. Back with us, PGIM's Mike Collins, iCapital's Anastasia Amoroso. To the both of you, thank you for being so patient as we work through that White House interview. Anastasia, is there a mechanism? Is there a world that you can see where inflation comes back down and unemployment goes lower too?
Well, there is a scenario. I'm not sure if it's a plausible scenario, but the scenario is we need to find more workers. We need to find more capacity of housing, of semiconductors, and everything else. I mean, if you think about it, John, that's been the biggest problem with inflation right now is we have had extremely easy monetary policy for the last 14 years. So we've stimulated the demand, but we didn't use that time to actually invest in capacity. We didn't expand our labor force. We didn't expand our housing stock. We didn't build a semiconductor capacity in this country. So the solutions that are required, unfortunately, are more longer term in nature. So I think what the labor secretary said and making sure that labor is available to work, that's important, but it's likely not going to be enough. It's not going to address the wage gains that we're having, the fact that there's 2 job openings for every unemployed person. It's not going to address that we are short 3.8 million of housing stock right now. So unfortunately, in order to bring supply demand back into balance, we have to bring down demand because supply is just not caught up yet.
Mike, can we have that miraculous supply side solution?
Jonathan, we can have something close, right? We can have, as Anastasia said, demand coming down. We can have inflation coming down. I mean, all of the leading indicators that we look at indicate that supply chains have been mostly healed, especially in the goods sector, right? So you're seeing inflation coming down. I think you're going to see unemployment go up. So that's this whole soft landing we're talking about. If inflation, ends up at 3.5 in a year from now, which I think is really likely. I'm talking like core, PCE, and the unemployment rate ends up at 4 or 4.5. I think that's a really positive world, and maybe that's what the Labor Secretary is hoping for.
Well, let's talk about that positive world that you want to invest in. Mike Collins, Rick Reader, earlier on today, about 40 minutes ago, and over the weekend in the Journal, said he was more excited going into 2023 than he's been in a really long time. Mike, do you share that enthusiasm in fixed income? It just seems to me that people in the bond market right now seem to be pretty excited about what they're experiencing.
Yeah, Jonathan, I've been back on the road talking to hundreds of our clients, and they are all getting excited to go back into public fixed income, to add duration, maybe not go down too much in credit risk. I kind of agree with Rick on that point, even though to Anastasia's point, the fundamentals of the companies are actually really good, right? That's where you have this big dichotomy. I mean, the macroeconomists see the world kind of unraveling. The bottom-up analysts, and we have a ton of them, look at these companies and say, actually, they're doing okay. So that's why you have this kind of weird dichotomy in the market.